right.
Awesome. All right, so we're back online. So I'm an accountant by trade. So I've had about just over 15 years of experience in the industry. And in the industry, I'm talking about hedge funds, audit, private banking, uh, uh, hospitality, a little bit of that. Health, health and medicine. One of my former coworkers, I got a client here as well. So I got some people I know, right? So I can lean on you. A couple coworkers in there, former coworkers. So I started my company just over 2 years ago, February of 2023. Um, you know, one of my mentors told me a long time ago, sometimes it's better. Eventually you can get kicked out, right? Wherever you are. You get comfortable nowhere except for your own home, and even there sometimes. And he always said to me, sometimes it's better to jump than to be pushed. Because when you jump, you have a better chance of landing on your feet as opposed to being pushed. Well, I was pushed. But sometimes you need that push, right? And so it's been just over 2.5 years of that. And so I'm talking to entrepreneurs as an entrepreneur, right? This is all I do. I don't have no backup plan. I don't have no side hustle. This is it, right? And so seeing me here, this is just a testament to my commitment to you. And hopefully you have the same level of commitment to your companies as well. So that's me in a nutshell. So I guess we can get started, right? So I guess maybe by show of hands, I just want to kind of get an idea of how mature your businesses are. So by show of hands, like anybody's been in business less than 2 years? Less than 2 years. Okay. What about 2 to 5 years? Okay. Anybody over 5 years? Okay. So a good mix. A good mix. That's good. I just wanted to get it just a bit as to what we're dealing with here. So we're gonna just jump right into it, right? So cash flow management. So I thought this was synced. Let me see. Yes. Ariel, you could, yeah, please. Let me see. Okay, I think I got it. Okay. Okay. All right. So when we talk about cash flow management, and again, business management, business activity is not dissimilar to your personal life, right? Your day-to-day. Everybody in here, I'm sure, has a certain budget in which they have to operate their personal lives. Some people have kids, some people have dependents, some people just have to take care of themselves. Some people have employees, some people have co-workers that they deal with on a day-to-day basis. And all of that is a part of how you manage yourself. The business is similar, separate, but similar. So cash flow management, when we talk about cash flow management, we just really just talking about, well, let's talk about cash flow first. Cash flow is pretty much the flow of funds into and out of your business. That deals with timing of inflows, timing of outflows. It deals with how you bill. It deals with how you collect. We talk about discounts, refunds, and we also sometimes get into conflicts, right? As business owners, we are bound to make mistakes. It's just a part of a part of it. Sometimes you could do everything right, have a customer, have a client that is just not working with you that day. And even though you may have done everything that you think or thought that you had to do, sometimes you have to give a little. And I think the give is really the difference between cash flow management and profitability. So when we talk about cash flow management or cash flow in a cash flow statement sense, we just talking about strictly cash in, cash out. When we talk about profitability, that's a bit more of an accounting term in the sense that profitability or profit and loss statement or income statement, which you're going to get into in our third section of today's session, is looking at your revenue, right? How much money you've earned, how much money how much expenses you've incurred, and what you are technically have left at the end. Either you have positive profits or you have negative profits, right? Well, you lost it, right? So a negative profit is a loss. But that is a pure accounting term. When we talk about cash flow, and we're talking about small, medium-sized businesses, growing businesses that need to scale up and advance. At this stage, I would argue that cash flow is much more important. And what are the key differences, right? So some of the key differences between profitability and cash flow are one of the first things I can think of is non-cash transactions. So a non-cash transaction, there's not a lot of those, but when we like a non-cash transaction is something like depreciation or amortization. Anybody know what that means? Show of hands. Have y'all heard that term before? Okay, amortization and depreciation. So they two sides of the same coin essentially. Basically, what that is you. So when you so let's just say you have a bakery and you have to actually buy industrial stove and sheets. I don't really know much about bakery. I shouldn't choose that example, but I know you need this. I know you need an oven, right? At least one oven. You probably need some sheets. I can't really cook either, right? You probably need some ingredients, the flour and the sugar and these different things, right? Chocolate chips and all that kind of stuff, right? The things that the expenditures are actually what we call assets, meaning something that carries value and has sustained value over a period of time, are things that are we would call capitalize those things. What does that mean? So I go in and I buy Master Technician still open? No, they close it. They open. They still open on Market Street, I think. Anyway, so you go into let's just say Best Buy. They probably close too. I don't know. And you buy a stove. Let's say you have to spend $10,000 on a big stove, right, with all of the different burners and all the stuff. When you spend that $10,000, that's a cash outlay, straight out, right? So when you either use your card, you swipe, or you go inside with your cash, you spend the money, that's gone, right? So that's cash outflow, right? That means that's money that's no longer able to be used to purchase inventory or anything like that. From a profit and loss perspective, that's actually an asset. So when you look at your profit and loss statement, you have incurred no expenses yet on day one. That actually goes to your balance sheet. And I don't want to get too wonky with it, but it goes to your balance sheet. What we do is when it goes to your balance sheet as an asset, it says that this is something of value, something that just is not a one-time purchase that you have to just write off. It's so when we say, okay, we buy a stove, what's the average useful life of a stove? How long you think a stove would last you? It could last a very long time. Let's say 20 years, right? But from an accounting perspective, we want to be as conservative as possible. So we say we want to show that as a value of maybe 10 years if it's a brand new stove, right? And we want to amortize that $10,000 stove $1,000 a year until it has technically zero value in the book. So depreciation or amortization is that $1,000 every year hitting your profit and loss statement as an expense to show the reduction in value of that asset, right? Just like when you buy a car, they say as soon as you drive it off the lot, it loses 20% or something like that. That's not really true, but it does lose value as soon as you take it off the lot, right? So whatever that value is of driving it from the lot off or onto the road, that $5,000, that is depreciation because you can't sell it back to the dealership for the same price, right? So that's just an accounting perspective. So that's one of the first things. There was a non-cash activity, which is a big difference. One of the other big differences between cash flow and we covered this just now as well, not example. Cash flow and profit and loss is the purchase of assets. So we don't. That's kind of two sides of the same coin. One of the other things that is a difference between cash flow, technically speaking, and profit and loss is when you inject capital, whether by getting a loan or you inject it from your personal funds, or if you bring in shareholders or a shareholder and they invest capital into your business. That is not profit. It is not income. It is simply a cash injection. So what that does is, and it's a quick example from an accounting perspective is, I have a business. Let's just use the bakeries again. And I bought one stove, but I really realized that to scale up to actually make more sense, I need to buy another stove. I don't have $10,000 to buy another stove right away. So I go to one of my friends or my family members. If you have good family, you have a family member in there too. I won't point them out. But if you have good family members who could go for that $10,000, that's good too, right? So let's say I go to my cousin. I say, hey, cuz I really need this $10,000. And he says, okay, well, I don't want to just give it to you, right? I don't want to just loan it to you, but give me a piece of the business. So we come up with an equation to say, okay, that $10,000, maybe that's worth about 20% of the business. I'll give you 20% of my business and ownership in the company. When we do, you got to be optimistic. When we do make profits, you get 20% of the profits, essentially. for your $10,000 investment. That is a cash flow, a positive cash flow, cash $10,000 that you have in the business now to either buy more equipment or to buy materials or to pay rent, payroll, etc. And so that's positive cash flow, not hitting the profit and loss statement, right? So we start to see where already cash flow is much more, and I hesitate to say much more important, but it's much more real time, day to day. You know what I mean? It's physical, right? Especially when you're starting out or when you're growing, when you may be a little bit stuck at a point, you need to get to another point. Profitability is good, but sometimes profitability is more of a theory than a reality. And I'll get into that, right? Um, so one of the okay, so one of the things that I always encourage my clients to understand on a day-to-day basis is, again, with this profitability versus cash flow model, is understanding where you are at any point in time. What do I mean by that? So again, I have sales of, let's say I have sales of $5,000 for the month, right? Not a bad month, but I have credit terms to some of my customers, right? So out of that $5,000, I've only collected $2,000, right? So I have to pay rent of $500 at the end of every month. I have a stock complement of two people. I have to pay up to $1,000 at the end of that month, right? So right there, out of that $2,000 I've collected, I have $5,000 profit, but I have $2,000 in the bank, and I know I have an obligation of $1,500 like in a couple of days. So really, I only work on $500, right? Um, that $3,000 that you haven't collected, you recognize it as revenue, and then we don't even get into this at this point, right? But like when you are accounting for your operations, and when you, let's say we file in VAT, you make $5,000 on your VAT register. You've collected $500 for the government, right? Well, you in theory collected $500 for the government. You really collected $200 after the 2,000. And this is also VAT filing period. If you all file VAT is due on Monday, right? File and pay by Monday or face a 10% late payment fee, right? They don't play with that. And interest accrues daily. So that's the whole next thing. But again, real time example, right? So not only do you have a $1,500 obligation between your rent and your salary on your staff payroll in a couple of days, you've only collected $2,000, but you also owe the government $500. So really, today you have $2,000, but really you have $0 already, right? So that's a pure difference between cash flow and profit and loss, right? So we have to always remember um to manage our receivables and manage payables. One of the key basic rules of thumb in accounting is you try to delay payment of expenses for as long as possible, and you try to accelerate the collection of receivables or revenue as quickly as possible, right? It's just it's a timing game, right? Because again, that $3,000 is profit or revenue, but the business might be closed or you might be evicted before the $3,000 comes in. You know what I mean? So it's very important to recognize that. And we're going to get into some of the ways in which you are able to speed up collections, delay payments without having a bad name on the streets, right? Which is also very important. So what are some of the simple ways you can manage your cash flow, monitor your cash flow, right? The number one tool that I use when I'm preparing financial statements for my clients is the bank statement, right? There's a huge caveat with that though. When my clients are sending over their bank statements, the first thing I ask them is a couple of things. I say, one, what percentage of your sales do you actually collect in cash, right? People say cash is king. That's true. But for accountants, cash is kind of like the enemy, right? And I'll explain why. So I say, what percentage of your revenue collect in cash? What percentage you get wire transfer or credit card swipe, right? If they say anything, they collect cash, anything over 40%, I'm very skeptical of the bank statements before I can get them. Why is that? The chances of you depositing your money, your cash that you've earned into your bank account, is very, very low. It's very, very low. And that's just the way of life in the Bahamas, right? We are a very cash-centric society. And personally, and I had to do this personally before I was able to do it professionally, is I use as little cash as possible. There are many benefits to that. One of the benefits is when people ask you to borrow money, you don't have it, right? Just a practical, but I mean, people have online banking, right? But I don't know online banking. If you come off the street to ask me for $50, I come on, man, I don't want a bank transfer. You know what I mean? I don't have the cash, I don't have it, right? So that's a good, I joke about it, but it's that's a real life example, right? Um, I had to train myself personally not to deal in cash because when I had that stock cash, and I was never a person to have a bunch of cash on me anyway, you tend to spend a little bit more freely, right? So I just had to stop that personally. Um, what I did, my profession is a bit different. I'm not a retailer, I'm not a trader, right? I provide professional services. And so for the most part, most of the things that I do is right on this computer, right? And so and that includes payment of bills and receipt of revenue, right? So that's a good thing for me. But there are times I do have a client as an example. He's a mechanic, right? He's an old school fellow. He probably don't know the ATM card. And he makes me come to him in Augusta Street to collect my cash. And believe you me, whatever I ran, if I ran code suit, I go on Augusta Street and I collect in that cash. You understand? But what I do is because what I used to do is initially I used to just use the funds, right? And this is I talking a professional accountant, right? So if you fall into this category and making the mistake of spending your cash, don't feel bad. Accountants, doctors, lawyers, whoever people think is high society, we all have issues we deal with, right? Especially with finances. And I used to just spend the money. And a common accounting term is if it's not documented, it's not done. And I would translate that into if you don't have if it didn't hit the bank account, or if you don't have some sort of paper trail for that money, you didn't make it, you didn't earn it, right? And we'll get into that as well when we talk about going to the bank or going to the SBDC for financing, right? This all ties in. So what I do now is when he does call me, on occasion he does call me to collect cash from him, I take that money right away. I run to the ATM and I deposit it into the bank. Even if because there were times, particularly early on, the first 6 months of that business, when I started this business, it was rough. So I needed that. Like if I get $100,000, I need it right away. I got to use that, right? School fee. You all know the rundown, right? But I would run to the bank, take that $1,000, deposit it. As soon as that fund's clear, I go right back to ATM, or I go and I swipe that money, right? What that does is it starts a paper trail, right? And if I needed to go to the bank at some point and say, hey, I need to borrow $50,000 for down payment for building so I can move into that, right? They'll say, well, Mr. McCartney, where's your source of funds, use of funds, y'all know how that go. And I'll say, well, if you see the paper trail here, this last 6 months, I could demonstrate I'm depositing $6,000 a month. I may be withdrawing $6,000 a month, right? But at least they can say it was there, as opposed to uh, you, you know, I have other clients tell me, man, I've made up to $50,000 in 1 month. When I ask for the bank statements, get back to the question that I asked at the beginning, they may have $3,000 deposited. You know what I mean? And that is not the only issue because there are the other procedures that you can put in place to mitigate non-deposits. So when I get that cash question, I'm skeptical if it's a high amount, 40, 50, 60% of your revenues in cash. Then I ask you, okay, how often do you deposit those funds? And I also have clients who are in out islands. And if you're learning about, let's say Luther, right, which is very Long Island, you might have two banks in the whole central and south of Luther. That might be a lot, right? And if you are run a bar and grill and you got to drive 10 miles south to deposit money into the BOB ATM, it's very unlikely that you're doing that on a daily basis or even a weekly basis. And so a lot of that money just kind of goes into funding operations. And I've had a client who I had to tell, like I did a lot of work for her, and trying to do some forecast. And I had to just simply tell her, like, to be honest, I can't even charge you because I can't produce anything for you. And that's the last place you want to be, where you go to an accountant if you need to and ask them to prepare statements and they refuse. Because, I mean, there's a certain ethic to this as well, right? And if you can verify certain earnings, especially, you you can't sign your name to it, right? You got my license involved. I got just the integrity, right? So it's a lot that goes into it. But mitigating factors to account for non-deposits is like if you keep a cash log, right? If you keep all your receipts. So for example, if you made $10,000 in a period, you deposited $2,000. That's an $8,000 gap. If you can prove that $8,000 in terms of expenditures, whether it be receipts in terms of like you buying food from the grocery store, you paying payroll, you paying rent, and you have your receipts for it, I can make it for income statement for you. I can say, okay, well, this $8,000 is accounted for, boom, 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 right? And we could work with that as well. But you need to have documentation of that $10,000 needs to be documented. Where you can't document it, I can't account for it. So if you could only show me $8,000 of either cash deposits or expenditures, I only could account for $8,000 worth of revenue, right? And so we see how it's very important to try to minimize cash where possible, and where we are not able to minimize cash receipts, you account for it or you keep record of it, right? On that point though, in terms of talking about trying to minimize cash, one of the key things that y'all would know is when you're in business, you want to make payments as easy as possible to collect, right? So if a person and people do this now with online banking, I'm not sure why, because I think people sometimes feel like it's a penalty to do different banks. Sometimes maybe it is a fee, I don't know, right? It depends on the bank. But if somebody say, okay, which bank you bank with? And I say, I bank with Fidelity. I do bank with Fidelity. And they say, well, I only have RBC. And I'm like that could work. You know what I mean? But people, yeah, there is a fee. So that's probably what it is. That's probably what it is, right? But let me give you an example of that. So like if a client owes me $500 and they say, look, I mean, that can cost me $5 transfer, I'll say $74.95. You know what I mean? That's a $5 loss, but that's $4.95. You understand? And that's again a very simple example of cash flow versus revenue, right? Cash flow is way more valuable than revenue when you need to keep your business going, right? And so sometimes you just have to make those quick decisions. You have to make sense, obviously, right? I'm not saying to take 10 cents on a dollar, but I've actually had to take 10 cents on it. I'm going to tell you a quick story. Just give me a second. So, and I segue a lot, but I think it's valuable. In my profession, again, I don't sell shoes, clothes. I don't do shipping. I don't do what I don't sell numbers. I don't do none of those things, right? I provide a service. Oftentimes a service that you can't see, touch, or feel, right? So that in and of itself is already, unfortunately, a discount in a lot of minds of the humans. The reason why law firms are so profitable or so, again, profitability. The reason why law firms make so much income, so I'm gonna say they are profitable, is because you need lawyers to do a lot of things. If you didn't need a lawyer to convey a piece of property, a lot of these law firms are closed in one day, right? But people don't go to lawyers because they like lawyers, right? You need a lawyer. A lot of people feel like they don't need accountants, and not everybody does need an accountant. I'm not trying to plug my business, but a lot of people do need accountants, even if it's just for temporary or one-off services. Um, and I lost my train of thought. Okay, dollar 10 cents, right? I did some work for a client, and she said to me, how much will this cost me? And I said, well, we could do it two ways. We could do hourly, or I could give you a fee and you agree to pay that for a set of numbers. And she said, well, I am sure if I want to do, because when you had okay, let's say to do produce numbers, this costs $1,000, right? But I said I could charge you $60 an hour. I can go to hourly. That's the thinking that a lot of people have. Okay, $60 is less than $1,000. But I said hourly work is very expensive, right? In any industry, hourly work is extremely expensive, right? Because it comes with discovery, it comes with sometimes a bit of inefficiency, sometimes the customer or the client is inefficient, but you know, just because you didn't give me the information I needed doesn't mean that I didn't do the work, right? So you may have given me some numbers that weren't even relevant. I did the work on those numbers. Oh, I send you the wrong statements. Okay, send me a new statement. But that work that I did, I can still charge you for it, right? So this is all wraps into hourly. I did the work for her, and I produced 6 months worth of statements, which is a lot of work, right? And so I said, here's my bill. She said, can we have a meeting in person? I said, sure. Now I don't know. It ain't looking good, right? So I drove down there. We had the meeting. The first thing she said to me was, I I'm extremely surprised by the bill. I said, okay, let's talk about it. You want me to explain to you step by step how I did what I did and how I got to the fee? As I don't just charge clients just and other thing. I try to be fair when I do my work. I try to look at a sustainable long-term relationship, right? Because you get a one lick off of somebody and never see them again, and mess up your reputation, and a one-time payment for me is not my business model. I need recurring revenue. So then she said, I trusted you. So now I started using words like trust, integrity. So now I itching, right? Like I feel like you know what I mean? I just add some pre-workout. And now I really little agitated. So so I was like, okay, let's just cut to the chase. I said, what are you willing to pay? Let's say the bill was $1,500. I said, what do you think these numbers were? I already gave it to you, right? What are these numbers worth to you? Well, I don't know. I can't afford this. I said, what can you afford? She wouldn't give me a number. So that means nothing, right? In my mind, I made an emotional decision, but I don't regret it. I said, you know what? Now, let's say that work took me 2 weeks to do, right? That's a lot of time. It's a lot of effort. Again, this is like probably the first 8 months, 9 months of the business. I don't have it like that, right? Thank God for my good wife who's able to assist me with, we have children, right? So it's like you again, cash flow, profitability, right? That bill was already on my income statement. That's revenue, right? Um, but I hadn't collected a dollar. I wrote off the entire bill, right? Didn't tell my wife until later. Um, I wrote it off. It was an impulsive decision. I probably could have caught a better deal for myself, but I just felt like when I hear words like integrity, trust, lack of trust, I just didn't feel comfortable. And I said, these 6 months worth of numbers are yours to keep. I wish I could take it back, but I couldn't take it back. I already sent it to her. I said, if you need me in the future, you could still call me. I'm mad now, right? So I just lost $1,500 or whatever the number was. I said, but if you need me in the future, here's what my fee is, and these are the terms. Pay up front. This is what the fee is. And she didn't call me for a while, but she did call me after about 6 months. She said, you know what, Anwar, like I really need you. And I really wanted her to say, here's the $1,500 up front. You know what I mean? But but I cut that deal. I said, but we actually still work together today, right? But at the time, and so that was even 10 cents on the dollar. That was 0 cents on the dollar, right? But sometimes you got to make those decisions. I hope that doesn't happen with any of you. And there's always again, back to my intro in the beginning, trying to continuously critique myself, trying to continuously be accountable to myself and to others. And I said, what could I have done differently in this situation? Probably one of the things was get a deposit. But the main thing I said to myself was, you should have communicated properly, knowing that this person had financial limitations and said to her at each stage, here's where we're at. Are you comfortable with this? You know what I mean? Because there's always ways to mitigate hard times or disagreements. And it may have still had a similar result, but you have to hold yourself accountable. Again, when there's disagreements, you're not always at fault, but at the end of the day, you have to take what comes with the job, right? So the bank statement is number one for cash flow management. If you have an average positive bank balance, and if it's like, so for me, I have a number in my head that I like to see my bank account at, right? The business bank account. And if I dip below that, now I looking at receivables, I looking at what's going on. Did I pay a bill too fast? Did I duplicate a bill and I paid something twice? And I'm making calls, right? Talking to my clients, hey, can we get some turn on the account? Sometimes you gotta use flowery language too when you're in my industry, right? You can't. I say, hey, where my money is, right? You gotta be like, how things, I sent you a statement a couple of weeks ago, do you want to discuss it? You have to be upfront. You have to be out there, right? But you can't offend sometimes. And again, this is a very small society, very familial society, and you may say something to a person, and you may have the best intentions. And then now these phones. My parents want me, but these phones. But that's what it is, right? They go and, oh man, this man, he's a fake accountant, and he charged me extra. He ain't even give me the work. It don't matter that none of that is true. You could be marched on. You know what I mean? Just off that one interaction. So And sometimes it's unavoidable, but I try my best to think like, what's the worst that could happen and the best that could happen? Let me try to stay close to the best. Worst case scenario, smack dab in the middle, right? Um, so that's something that you have to consider. But I have a number in my head, so you should have a number in your head as to like what is a good space? When am I in danger, right? I don't have an overdraft in my account, but I know a lot of clients have overdraft facilities, and I'm very pro overdraft facility if you have uh, solid cash flow, right? So if you let's say you're a shipping company, you have to have a lot of cash outlay to bring in shipments, and sometimes you don't get paid until afterwards, right? So you may have be comfortable having a $20,000 overdraft facility, right? You can catch a little interest on it, but in a couple of days you can get 40 grand in, so it can go up and down, up and down. So that may not apply for you, but I have a number in my head at all times as to like what I need to be comfortable, so I go to sleep tonight, right? That's just a part of being an entrepreneur. Sometimes that's one thing I had to get used to, like never turning off your brain, right? Because when I was just an employee, you could do your work or not do your work. Friday, happy hour, weekend, Monday, pick it up where you left off. When you're in this game for yourself, is none of that. And you all are here, so you all know that. The balance sheet is also a good indicator of your cash flow. What do I mean by balance sheet? Anybody know what balance sheet is? Y'all familiar with that term? Balance sheet? All right, so for those who don't know, a balance sheet is a snapshot in time as to like what is the business's worth, quote unquote, at a particular point. So you have three main components of a balance sheet. You have assets, right? So when we talk about assets, cash is an asset, something that you actually own, right? Cash is an asset. Receivables is an asset. Accounts receivables meaning money that you've earned but not collected yet, right? We talked about that earlier. I can keep coming up, but it is an asset, but it's an asset that you have to watch very carefully. It's almost like if you own a pile of sand, you got to watch that sand and make sure it ain't going down without you getting your money for it, right? Because if it goes down and it's down to nothing, yeah, asset is nothing, right? And that's what receivables are too. If you don't watch it, continue to monitor it, continue to check up on it. If that's your business model. If that's not your business model, you don't really have to worry about it. But if your business model includes some credit terms, you got to keep on that, right? What else is an asset? Inventory is an asset. You have like assets like equipment, machinery, and that kind of stuff, right? You might have building. If you're building, congrats to you. Good job if you're building in your business name. Vehicles, there's those assets as well. Then you have liabilities, meaning what you owe to people. So payables. So you have a bill that you let's say you have a payment terms with your business license or your VAT. You couldn't pay it all at one time. Come up with a payment term with inland revenue. I just want to segue there for one quick second. I see this all the time, and I it costs my clients a lot of money. Continuing to have a very proactive and as much as possible positive relationship with inland revenue. Everybody has to deal with inland revenue to some degree. If you are VAT registered, you have to deal with them on a very frequent basis, and sometimes you're talking about a lot of money, right? But I have a lot of clients who, similar to like when you have a personal credit card that you swipe and you go away, and then you don't check it for a while because you know it's bad, but like you just say, I can look at it right now. I used to have that issue too a while ago, and I had to stop that, right? When I know things was looking good, I would check my account all the time. Like, come on, man, good job. And I'd feel, I'd congratulate myself, man, look here, you got $1,000 in the bank, and you have a $50 balance in the credit card. You could even pay it off, right? When I come out from away, I'm looking at that for weeks. Meanwhile, interest is accruing, right? You may be getting duplicate charges, banks make mistakes all the time. So just that's another segue, right? But with inland revenue, I see people make mistakes a lot of times, and I think starting last year they had become a lot more punitive. The government, not getting political here, but it's just a reality. And when you don't check that account money and you owe the government money, it never goes down, never goes down, right? It only could go up. And if you're in a particular industry that requires you to have an active, well, everybody should have an active business license. For certain things you need it like on hand, or TCC, or what do they call it, with the tax compliance certificate. Some people have to do it every month. If you are not current with your NIB, real property tax, business license fees, VAT, I think that's the main ones, you will be denied a TCC, right? So I have a couple of clients who are in the shipping industry, and I telling you, they on the dock saying, Anwar or Mr. McCartney, depending on the level of relationship, I have this shipment I need to bring in right now. Can you check the account? And I say, well, Mr. John Doe, you ain't paid VAT from last quarter. You owe 10,000. Um, so I need you to do something for me. I'm paying that 10,000, right? So what you need to do is, if you can't pay that right now, go to run to wherever in land revenue they always moving around. Go wherever they are in Michael Road or wherever they located, and sit down with somebody right away and come up with a payment plan, right? Again, that's just like checking the credit card when you know it's bad, because sometimes it could prevent you from actually operating. And the government, people don't notice sometimes, but the government could at any time shut you down. Like they could just come there, shut you down. If this is a business right here, and we talking now, they could come here and say, "Oh, I'll go home, please. It's over." The government could do. They could basically subpoena your bank statements if they feel like you're committing fraud. So it's a lot of power that the government has via Ministry of Finance that we don't think about on a daily basis. But you have to, as you make more money, you have more responsibilities to the government. That's just a reality. So when you're thriving, it's what they say: with great power comes great responsibility. Always keep that at the forefront of your mind, right? And so when we talk about, and this is the last thing I'll say, I think we may be running up on time for this first section here. But when we trying to monitor cash flow, you could look at your balance sheet and say, where are my receivables at? Are they growing? If I had $6,000 last month that's owed to me, now I have 20,000. That's $14,000 that I just let not be collected. You know what I mean? And I wonder why I can't make payroll. So it all ties in, right? Everything flows as one. And then sometimes too, you realize that you are actually operating at a loss or a cash flow deficit. You have to be putting in injecting money in on a regular basis. Sometimes that is a part of business where things might just be slow and you have to kind of make ends meet. But sometimes you have money floating out there that you need to actually go and bring in, right? And when things like my really bad negotiating tool earlier, where I just wrote off the whole bill, sometimes you offer discounts to be like, hey, look, and it could be seen as rewarding bad behavior, but it's just a fact. If somebody owes you $50 and you need 50 and you need $30 to get gas so you can make it home, you might take that $30, right? And it don't feel good, but some things you just have to, and that's what we call a write-off, right? Try to keep those at a minimum, but don't get so attached to the number that you have charged and that you feel like you're owed when you're dealing with people who may not be dealing with you in good faith, right? So it's give and take, as judgment calls, but that's a part of doing business. So, uh, Ariel, are we in terms of time? How we looking? We good? Okay. Um, so I guess we could maybe take a quick stop there for questions. If you all have any questions, comments so far, anything that might be kind of sticking to the front of the back of your mind.
Is it true that the bank they cannot charge for custody of property? For instance, if my bill is $100,
Mhm.
I know I'm only gonna get $95.
Yeah.
That's right. Like 5%.
Oh, you mean, so I think that's two questions. So I'll answer the first one. What I think is the first question. You can't, if your price is not, you said $100 or $90? Right. If your price, your listed price is $100, you can't charge more than $100 to make a credit card fee. Right. I think that's against the law. In fact, I know it's against the law. Right. Right. So you can't do that. That's the first side of it. On the other side of things, yes, once you swipe a credit card, the average the highest average that I've seen is like 4.25%. Right. That's like the baseline they start with. So if you just, all right, I want to open up a merchant account, give me a credit card machine, they can charge you 4.25%. So off of that $100, you only can collect 90, 95, 75. That's pretty good. 95, 75. My math is, I got a B in BGCSE. I didn't get a. So yeah, so credit card charges are real. And then also VAT, right? So VAT is that VAT is depending on if you're a VAT register. If you are a VAT registrant, that's a cash flow issue. If you're not, that's an expense. What does that mean too? So if you collect and pay VAT to the government, any VAT that you pay, you could offset. So this is a cash flow issue. So if you collect $10 on a $100 transaction and you pay 45 cents on that credit card swipe, you have to pay the difference, right? So that's okay. But if you don't charge VAT, you that 45 cents is an expense to you, right? So that goes straight to the profit and loss, and it's a loss for you. That's something to consider for y'all as well. If y'all teetering on the edge of that VAT ability line, sometimes depending on the industry that you're in, especially if you buy and sell, it's usually beneficial to be a VAT registrant, so you can offset that money. But yeah, you can do that, and that's something for you to consider as well. One thing I see people do, and I've seen it in the past, and I don't know if I see it regularly now, because this may also be against the law, is giving cash discounts, which is, it may seem like you losing, but maybe the real price is the cash price, and they kind of mark it up for credit cards. Because like it's just, I ain't gonna call it a name, but it's like I think it's this plumbing place that had a sign where they say we offer 5% cash discount. And maybe that was their way to say, all right, if we get, like, I talking cash or checks, if they collect checks, you pay me $95 instead of $100, but maybe the price really is $95. And the $5, if you're paying by credit card, it's just a bonus. So and that's off the 95. So there's ways you could do certain things. But I would say too, before any more questions, when we talk about credit card charges and the fees therefrom, there's a cost benefit analysis that you have to do for every business, right? How many sales have I lost because I didn't have a credit card machine? That's something that you have to, like, and again, it doesn't have to be scientific data that you collect all the time, but you could just, like, if you have a store and you have 20 customers in that day and 5 of them come and say, I only have a credit card, and they want to spend $50 and you say, yeah, I don't have it. And they just walk out, that's $250. Mm.
Before they released it. Seemed to
Oh, wow.
I put up the font. I thought, yeah,
Right.
I still sweat.
Exactly.
Over there.
Yeah,
Good time.
absolutely.
And then I kept making the font, part of the business license and everything, but I didn't know what business account.
Okay.
I thought I was putting this money in something, I had his name and on that account. Then the bank said, oh, we give you a limit for your personal account. What's your source of income? And I was like, you know what my source of income is? Is the license. He's like, no, you have to open a business. No, I was like, what's the difference?
Yeah.
And finally got on my banking, I look, it's like, wow, these people take out my money before it reaches to me. So they deduct for their percentage to the machine.
Yeah.
And they deduct the little back. I don't collect back the government. They deduct the back from the transaction.
Fees.
They deduct from every time you withdraw. And I saw the fees, $40. But this was $50. I was like, oh my God, these people taking out my money.
Right. Right.
And which is, for ease for my time. And good traffic, the came in handy with the inland revenue.
Right.
So when they was asking for certification, I could take a statement, like I think about it, upload it, see that it's a time of my life.
Yeah.
And then it caused me to track my spending better. What was coming in, what was going out. If I was being responsible, these things I buy was necessary, that kind of stuff.
Right.
I couldn't understand why you know, there's an account.
Right.
And a personal account.
Right.
And I saw it.
Yeah. And I'll just to piggyback that too, there's two reasons why a business account is necessary. And if anybody here operating that business, if you're all here, you're all serious about your business. If you don't have a business account, get one like next week. It can take, wow. Look at, it's a local bank that I've been trying to get a bank account with for like 2 years now, but I am in, someone not as me. I gave up on it. But there's two reasons for it. From the bank's perspective, they they need to know source of funds, right? So if you have a personal account and you was getting your salary of $2,000 a month, and all of a sudden now you get like $16,000 a month, that could be money laundering, that could be all that kind of stuff, right? Terrorism funding, even though, come on, $16,000. But they used to go through all that, right? So that's for them to protect themselves, integrity, yada, 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 right? So that's on the buying side. From your side, and I'll tell another anecdote too about my personal failures. And I like to talk about failures, right? For myself, to keep myself constantly in the flow of now, right? When I first started my business, and again, I'm a I'm a trained CPA. I've been off to school. I worked at Ernst and Young. I've been to all the credentials, right? Everything except for master's degree because I couldn't do 2 more years. And my parents spent all this money for me, private school. So I opened up this business, and I knew you know the truth, right? And I just didn't. I started the process, but I didn't follow up on the bank account. I even incorporated the company before I did all that stuff because you kind of have to do that. And in the meantime, I was receiving money to my personal account. I was just that was just getting swiped. And I talking about like I started to make significant amounts of money, and I just swiping. I didn't see any benefit from it, right? Obviously, the light is on, the waters were on, the car gas, and so you making money. You're functional. But from a business perspective, I couldn't account for how much money I was spending out of it, right? And what that is called is two things. It's called commingling of funds, and it's called you paying yourself way more than you think you're paying yourself, right? I don't know if we're covering that necessarily today, but let's just say I was my goal salary at the time was $5,000 a month, right? And that's important to just to say when you especially when you go full time. If you full time in your business, you need to set a goal for a salary that you have to pay yourself, right? Even if you cannot see a way to pay yourself that salary, the reason why you have to at least set that goal, have that in mind, is because first of all, if you're dependent on the business to fund your lifestyle, you can't set an unrealistically low goal. And when you hit that goal, you still can't. So I want to pay myself $500 a month. You can't do that with $500 a month. So you make that $500 a month, you pay that to yourself, and that maybe like the light bill and what gas. I don't even know now, and I don't even know. Yeah, man. So we ain't getting into cost of living right now. We ain't doing that because that's another topic, right? But I was, but then it goes the other way. When you don't pay yourself a salary, people sometimes see that as like a badge of honor. Like, oh, I work in this business and I pay myself a salary. That's a bad thing. That's a really bad thing because either you suffering and you run it and the business kind of just taken away from you and you really just suffering. What's the point of that? Um, or you living too good, right? So let's say the business brings in $10,000 in a month, and my goal is $5,000. And at the end of that month, there's $0 in the account. I pay myself $10,000. That's what it was. Like, so I didn't do a payroll transfer. The money came into my personal account. I pay school fees. We gone away. You know what I mean? I've been out to I don't go to those places anymore. But whatever it is, like tithe. You know what I mean? And I said, boy, I ain't pay myself yet. Yes, you did. Yeah, because like, I'll say too. Like one time I asked my client, this is a new client, so I didn't really have a familiarity with them. I asked them to send me the last 6 months bank statement, so I could kind of see what I was doing before I really committed to it, right? And she said, I don't pay myself a salary at all. So, Mr. McCartney, I really just like right now, I just roughing it. It's okay. The first thing I see, community college school fee. I say, what business, which one of the employees go to community college? Oh, that's my child. I said, that's payroll. That's payroll. So opening a business account is also good practice to you, and you training your business to absorb the full expenses of a business. Because a lot of people do have a business and they may be operating at the side of their house, or like they may carve out a piece of the living room to do maybe a hair salon or nail salon, something like that. It's good, right? Try to cut costs as much as you can. Oh, I don't pay rent. I don't pay myself a salary. I don't pay utilities. Yes, you do. You pay utilities. And now you plug in that machine again. I don't know about nails and hair, but you got to plug something into something, right? You also use the big thing over there. I don't use it no more. Oh yeah, my grandma used to take me with her and I used to be like, what's that sound? You know what I mean? Every like 2 Saturdays, like, I really don't want to be here right now. with the curlers and hair and all that. And so your light bill going from $200 or let's say 150 a month. If you have a 1 bedroom, 2 bedroom apartment, all of a sudden now you're operating the whole salon, you paying $600 a month, and you paying that. The business is paying that, or either the business paying it or you paying it. Um, you have to hire staff, but you say you don't know payroll. That's payroll. You know what I mean? Now you use your personal vehicle to make runs. All of a sudden now you're taking your car to the mechanic often, or you gotta get your oil changed like often, or your tires keep busting often because of the road. Um, and so all that is business expenses that if you are not separating, you're taking the brunt of it. Again, that we are going to sacrifice as business owners. That's a part of it, right? Sacrifice for hopefully a greater reward in short order, right? Or somewhere down the road. Have that vision, have that passion, have that commitment, yes. But you don't want the business to kill you. So treat it like a separate entity, right? Even if you don't open a corporate company, have a trading hours, open up that company. And for me, I remember too when I had to, again, just in terms of training myself to do things properly, because I was an accountant, but not a business person until I got into proper business. I used to feel silly when I got the account open. The money went to the business account, and it's all online banking. And I have it all the same bank. I feel like, why transferring this $2,000 from my business account to my personal? I could just take it out of the business, but no, you do it properly, right? And then when you go to the bank, again, that's the theme. Always think about financing. Always think about I can need to go to the bank, or I can need to go to somebody, or I need to bring a shareholder in. The more records you have to show positive habits, positive behaviors, even if you're losing, the better your chances of being able to source that money. Because it's all about getting that money to go higher, right? Um, it felt silly, but that's what it is. And I every 2 weeks or once a month, depending on how things go, I do that transfer. I label it the same way. I date it, and that's how I treat myself. You have to treat. I'm my own employee. I take myself seriously in business. When I go home, we crack jokes and play, but not when we doing this thing here, right? Any other questions? Are we good for now? Okay. All right. I talk a lot, so let's move on. So sales forecasting. Forecasting projections. When we talk about sales forecasting or forecasting period, are we familiar with that thought process? Trying to see into the future. That's basically what it is, right? So when you, no matter what stage of the business you're in, if it's day one, if it's a venture capital project, if you in the early stages, middle stages, or you mature in your business, you always need to know what comes next. Always needs to know what comes next. No matter what your business model is, you have to understand where the next dollar is coming from and where the dollars that I have now, where are they going? Because nothing stands still in business. If you standing still, you going backwards, right? That's a very I think that's a kind of very cliche sports term, but it really relates to life as well, right? So forecasting's primary function is to assist with making decisions. What does that mean? So let's say you 2 years in, you doing okay. You might have $1,000 in the bank account. You have two staff members, and you have one let's say admin person working with you. So you're saying to yourself, look, I see the market changing. I have a very, very small space right now. I work from home. I have the person come and help me at my house, but I need to make a move. I need to get a storefront, right? Um, what does that mean for me? So now looking, so looking 3 years out, or look, not even, let's say looking 1 year out. If I get this storefront, what is my business gonna look like, right? So I like to look, and we're gonna get into forecasting, and do a full model at the closer to the end. But just talking through it very practically speaking, I like to look at it from the expense side first. So me, I could be pessimistic when I need to be, optimistic when I need to be as well. But when you're talking about making an expansion in your business, you got to look at the expenses first. You have to, right? The dream is there, and that could become a reality very easily. But look at what this can cost us. So now I get a storefront. What's the rent on a storefront? Without, like, say a very small space. Maybe you could get somewhere $1,000 in the east, maybe, or somewhere central. Maybe not even that. But let's say $1,000, right? 1,200. So $1,200, right? That's what $300 a week. So now you go from paying no rent because you're working from home to $300 a week. You have to find $1,200 at the end of the month. What else you got to do? You got to pay utilities probably, and sometimes you may get that full package in there, but some landlords don't play that, right? So you might have to pay at least a portion of the bill if it's a building like this where shared space, they got a portion, a part of it to you. You have to pay for water. You have to pay for what they call CAMS maintenance. That's another scam. But let me not say scam, right? Let me be quiet. Let me stop that. But so now you go from having no virtual overhead to having like $1,800 a month that you gotta pay, right? Um, with the expansion, I'm hoping that you're gonna maybe try to serve more customers. So you may have to pick up another staff member or two. So now you go from paying your staff member $300 a week to paying three people $900 a week. So that's another $600 added on to your expenses. So we got so far, we got 1,800 plus that's $2,400 a month extra. What else? Now you serve more customers. If you sell something, you got to buy more supplies to be able to sell to more people. So that's all cash outflow. So before you sign on the dotted line, you have to know my expenses can go up by $3,000 a month minimum. That's a guaranteed minimum. Now, how am I going to make that shortfall up, right? And can I sustain this even in the short term? And then you get into like, okay, now we sign leases now. So we can sign a 1 year lease, we can sign a 3 year lease, 5 year, 10 year lease. So that all factors in, right? So the forecasting of it, and I love Excel, I love Microsoft Excel, but whatever tool that you like, whatever tool that you're comfortable with, use those tools to tell you, all right, that $4,000 or that $3,000 a month, where's that gonna come from, right? Because the revenue right now, you only could bank on what you're already making on a consistent basis. So my revenue has been $2,000 or $3,000. That already got eaten by the new expenses, right? In addition to the costs that I incur on a regular basis now. How many, let's just say we sell, give me a product, any product. Shoes? Hell, I don't know what number hell. But let's just say we sell hair, right? Bundles, that's how y'all do it in bundles. Let's stick with the bundles. Let's stick with the, I don't even get, again, I get too fancy, right? So let's say, so now I move in about 50 bundles a day or a week. I need to move 400 bundles a week, 200 bundles a week, right? So I gotta quadruple my sales. How am I gonna do that, right? Am I gonna increase my prices? Am I gonna decrease my prices? But sometimes you lose to win, right? Depending on volume. Um, where am I gonna be located? How does the traffic flow? Where is the market that way? Competition around me? Is it a bunch of beauty supplies all around me? I probably shouldn't go there, right? Um, where I am is that concentrated where a lot of actual salons are? Because I would assume when you sell in here, the proximity to salons is good. I assume, right? Or do I operate in an area where there's a lot of pedestrian flow, right? So Carmichael Road, a lot of people walk around. You know what I mean? A lot of people, work from home and that kind of stuff like that. So that may be where you need to go as opposed to going in the West, where you may see 10 people a day. You know what I mean? So forecasting helps with all that. So these are practical decisions that you have to make, but the numbers will inform that. Again, I don't know if it's again, I don't know if I made this point, but it's not all academic, right? I have on this wristband right now. It says I received 50 award points, right? My son, he didn't give it to me. He showed it to me. I took it because I liked it, right? And I put it on my hand because I'm not a hugely sentimental person, but I like to remember my kids as much as I can while I'm operating on a daily basis, right? And so I put this on and say, I like this, right? I look at the thing about my son, thing, but how he didn't go to sleep last night, smile, get back to work. So sentimentality has a place in business, right? That personal touch has a place in business to the extent that it benefits you and it benefits the business. When sentimentality gets in the way of dollars and cents, you got to remove that. It's difficult because, especially as an entrepreneur of a small or even a medium-sized business, it's hard to extract the business person from the human being, right? Because you put your blood, sweat, and tears into it, hopefully figuratively on the blood, and hopefully figuratively, right? But that's something that you have to kind of continuously monitor. Um, past performance is the highest indicator of future outcomes. What does that mean? That just means that what you've done in the past is most likely to tell you what you're gonna do in the future, unless things change, right? And you can't assume things will change, right? You can't assume that, just to segue for a second, if you want to lose 5 pounds, but you don't eat that well, you have a sedentary lifestyle, meaning you sit down all the time at work, you don't like to work out. In order to lose that 5 pounds, one or two of those things have to change, right? You have to eat a bit less, you have to work out more, or you have to move around and work out. You know what I mean? You gotta change something. You can't just say, oh, I'm gonna lose 5 pounds. That's a wish, right? You can't sit in the well. Unless you actually do some things to change your habits, your results won't change, right? And I'm here to lecture all about doing things differently, right? Especially, with weight loss. I ain't got nothing to say about that. But that's a big kind of factor that you have to factor into your forecasting. Forecasting is a future indicator. Lots of assumptions go into forecasting, but it has to be based on reality. So what I do for the SBDC pretty often and hopefully pretty well is I assist business owners like yourselves to go from the stage where you have the business operating or you want to start a business. You don't have a lot documented, but you know you want to go. You're looking for funding so you can expand. I don't write business plans currently because I just feel like there are people who are better at that. So I just try to stay in my niche. I do the financial statements for it. So I do both what they call historical financial statements, meaning what has actually been done, bank statements, do all that, reconcile, ask questions, make notes, all that kind of stuff. And then I also do forecasts along with that. A lot of people, when I say to them, all right, if you want to do a proper forecast, you have to link the historical with the future hopes. They're like, why? They don't like this is a different business, so why I gotta link it? You have to link it because you're not just gonna become a new person because you got $100,000 in funding, right? You're the same person, hopefully a good person, hopefully a good business person, hopefully a studious, hardworking, diligent, uh, detail-oriented person that is operating a business, if not profitable currently, on that upward trajectory. And that funding is only going to help you get to that place faster. You can't be operating like this. You get your funding and then you go like that. You have to connect those two things, right? And so I connected both figuratively and literally through the numbers. So the opening numbers for my historicals my opening numbers for my projections tie in directly to what you last did. So if your last income statement was a negative, so you took a loss in that last quarter of the last year, you starting out, ending off with that negative number, or we can change it, right? So the forecast, that link is, we recognize what it is, but it's going to be something different because we're going to do things differently, or we're going to have more ability to do certain things. And sometimes really all you need is funding, because a lot of problems with the business is release of scale. We don't have a huge economy, but we have a big enough economy. Like it's like you could move to Florida, and if you have the right idea, you could access 2 million people like a day or something like that, right? Especially online. Over here, it's a little bit different, and we still have older generation still is not totally online. So it's a changing society. So it's not as easy, but sometimes you just need that that push. And then market research. Market research is important. It's often free. It's not going to be perfect. It's not going to be one-to-one. But if you look at a competitor or a leader in an industry that you want to enter into or you're currently in, and you try, because a lot of information is out there. Some people and then sometimes too, like what I told my sister, I tell my children all the time is, whatever industry or whatever you want to do, be like an expert at it, right? I'm not a financial expert. I'm not a business guru, but I think I'm a really, really good accountant, maybe a great accountant, right? And I hopefully could add value in those other areas through my training, right? But you want to be the best that you can be, and when you're not the best, look at the best, right? So that's market research. So if you want to get into again, expanding your bundle, your hair sale thing, go to the big boys and just see what they do. Even maybe just take a look at their prices, right? You may say, well, I charge like $10 more for this. Hey, man. Now that may not mean charge $10 less because scale, right? So they may be selling 1,000 when you're selling 10. So that might not be for you, but there's little things you could take. You may say, well, they have all their nails behind the counter. Why they have that there, right? Or they have their small products behind the counter. Probably it's a theft, right? You may say, well, all their shelving or all their stuff in the front is clear. They want transparency. They want to see make sure their staff ain't thieving their stuff, right? So when you see businesses that are successful, especially successful over long periods of time, and long is it varies, right? Like in this day and age, I think if you've been doing well for 5 years, that's like a century because things change so quickly. You know what I mean? We like back in the day when you could have a business for 50 years and that's you ain't changed nothing, and there's people that's come in. I made a post out of there about on Facebook about Maiden's Wholesale, their logo, and they had a jingle, Maiden's Wholesale. And I was like, oh, let me see if they said they closed. And I was like, oh shoot. And I didn't even realize it's in Freeport. You know what I mean? Like I just thought that it was like everywhere, right? But those things are just not those like what they call foundational blue chip businesses is very rare, and it's going to be even more rare going forward. Things change rapidly, right? Sometimes businesses are only meant to be open for 5 years. You get in 5 years, do really well, sell or liquidate, and you get out, you do something else, right? And then on the market research point, I have here goals are a prism and not a prison, right? So don't be a slave to your goals. Your goals are important for you to kind of know what you want to do, measure it against what you're actually doing, seeing where you're falling down, seeing where you're actually overperforming, and you could maybe capitalize on those overperforming areas. But you don't want to be a slave to what you thought you were going to do. And I'll give you another quick personal example before I move on. So again, I'm not going to go back into what but I had a very, I would call, I had a very interesting relationship with money at certain points, right? So when I first started working, I didn't have any obligations outside of helping my parents with bills in the house. So that was a good situation for me. So I had very, very high savings goals, right? Like extremely high, like 70% of my salary I wanted to save, right? It's good, but like that probably should never have been a goal for me. Because what I used to do is when I hit that target, I was like, oh, I did really well. I saved that money. But when I failed, I don't know what it was. My brain had something going on. If I wanted to save $1,000 and I at the end that last day of the month, I only saved $600, I could spend that $600. I don't know. I can't explain it. I cannot tell you why I did that. So either it was 100 or zero. You know what I mean? If you went in first, you lost. I had a very weird relationship with money, right? And this is something again, like sometimes you have to psychoanalyze yourself. Like so when you have areas where you just keep bucking up or keep failing, or keep like, I have tension in this area of my life. Everything else doing good, but this is something that's weird. You gotta dig into that. You know what I mean? Sometimes you may need to seek some help for that, right? But you got because we only this you only have this one body, you only have this one chance. Unless you believe in reincarnation, which you may have 1,000 chances. I don't know. But I only believe there's one chance. So I try to say, like, hey, something ain't happening right here. Let me try to figure this out. And I was a prisoner to my savings goals, is what I realized. And when I fail, I just was like, man, I can break out of here and I can go on a shopping spree. And then when I get into the next month, I start over like crazy. Like, oh, I only have 30 days. All right, reset. But life don't work like that. Because that $600 could have been used towards something positive, you know what I mean? But I did that, and I did that many times. I was like, oh, this is crazy. And I was like, well, yeah, I know. So anyway, tomorrow's first start over. So you got to examine those things, right? And the same thing goes to business. Don't be a prisoner to your goals. Things happen sometimes. COVID happened. That threw the economy in the whole world for like 2.5 years, right? And we still kind of prices going up. Wages stay the same. So you know what I mean? Now we have to readjust to what it is now. Um, so it's just one of those things. You can, Dorian, for people who, I mean, the whole country, but mainly Abaco and Grand Bomb, like the whole 2 islands underwater, like how we thought that was gonna happen. You know what I mean? We couldn't have dreamt it. Uh, Certain external forces just happen. You have to just work with it. So forecasting and timing of forecast. So we already talked about how we look at it. So I like to build bottom up expenses first because expensive things that you could guarantee for the most part. Build that out so you know that you have to spend $4,000 extra to scale up. That's on a monthly basis. Then you plug in. You don't want to plug in the difference. You don't want to say, all right, well, I will make 2,000. I can sell $6,000 for the product. Not necessarily, right? forecast realistic goals. Take what you have now. So you say, look, I sell 10 a day. I have a very small space. I don't really market. So if I get a double my space, my square footage, if I double my employee count, and if I market, let's say $60 a month on Facebook, Instagram, TikTok, whatever it is, um, I could probably double my sales. I could maybe triple my sales. But don't say I want to 10x my sales, so I just can make 10x next month. It ain't happen like that. It may happen. It may happen. Maybe that's just the missing piece. But you want to start realistically. It's better to like set goals that are like more manageable, and then if you overshoot, leap for joy, and then re-up and go with that. So you could forecast monthly, quarterly. So for me, I do annual forecast. So I try to do it like November of each year for the next year, right? To say, okay, what I want to do next year. Um, it's important too, depending on what industry you're in again, to look at cycles, right? So it's, again, cash flow versus profitability. You want to average, say you want to average 5 grand a month in sales, but that 5 grand a month might be like 1,000 in January and like 6,000 in February and like 20,000 in March and like 1,000 in April. You know what I mean? So you have to learn the business and operate your expenses based on that. I gotta keep it going here. But budget to actual comparison. So what is this? What this is basically looking at the your budget, what your forecast was supposed to be for the first 6 months of the year. At the end of that 6 months, it's good to take your actual performance side by side. All right, I wanted $6,000 in sales. I actually made $4,000 in sales. I wanted to spend $4,000 in expenses. I actually spent 5,000, so I broke even. All right, not horrible, but I undershot my performance goals. How do I make up again? How do I increase sales, decrease revenue? I mean, sorry, increase sales, decrease expenses. Is that possible? Do I need to increase my prices? Again, forecasting helps with decision making, right? Do I need to do some more marketing? Do I need to sell different types of products? Am I buying too much Brazilian? Do I need to bring in more? Is another type of hair? Ethiopian? I don't know. um, then we get into break-even analysis, right? So I might too far ahead. Let me see. Um, Ms. Bindo, did you download the Excel worksheets? Uh, yeah, I think we probably should get into the let me see. Yeah, I think we need to get into the break-even analysis side of things now. Any questions while we wait? None for now. Any funny stories? Any interesting stories? I like to hear stuff. I like to tell it.
Okay, so I'm going to start off. I'm going to do a financial projection. And based on the goals I have for the business and the end of the year profit, the negatives.
Okay.
I know research says it's how is there a value of what on what is number versus what is not, and how can negative growth.
So the short answer is no. In the sense that there's no one number or one metric to say a business that only be loss column for X amount of time. It depends on the industry. You may want to share that fine. But it's a couple of things, right? So they said businesses tend to be in the loss or break even point for like 3 to 5 years, somewhere around that. I think it all depends on like what industry you're in.
Healthcare.
Healthcare, okay, healthcare, right? Um, I would say Google is a good tool for like AI, even if that's up. To find out like what are like what is a profitable healthcare company that's services or its products you sell it. What are the typical metrics? So you probably know like you get like US Canadian stocks, but you can scale it down, right? So if an average US company makes 20% profit, the Canadian company probably making like 12%. Because we got beauty and higher cost of living in certain, that certain states, right? So you scale that down, per sale, average price may be like $80, but maybe it'll be like $95 over here because it costs more to bring in stuff. So I guess it really just depends, right? Like I think, and that speaks to the call play. The main question I have to ask myself constantly from both myself and from my clients is this a viable business? Right? And that's a very, very hard question. It's like this sometimes answers like really rough for some people. But you have to really look across it, like you look at that right across it. And once you determine yes, it is a viable business, um, try to figure out, all right, can I utilize existing business that are a little bit more scaled up to my advantage? Like what they doing, kind of how can I change it? But I mean, I would say, and again, I won't give you like say, all right, you should be able to absorb 5 years of the losses. I can't tell you that. So it really kind of just depends. But here's what I would say: if you are increasing your sales every year, that's a good thing. It's good. It's a good sign. If you are increasing your visibility every year, that's a good sign. And if your loss, either dollar value or your loss percentage as compared to your revenue is going down, that's good. What does that mean? So if year one, you lost $2,000 and you sold $10,000, so like you have a loss rate about 20%, right? And year two or three, you making 50,000 and you lost the same, what I say the first time, 2,000. So let's say you lost, you made 50,000 in sales, you lost 5,000 in profit or loss. You just had a loss of 5,000. Your loss percentage is 10%. So it's getting better, getting more efficient while your sales are going up. Now, that's a good metric, but at the same time, like I don't have $5,000 to be doing, you know what I mean?
I thought that, what you said not to do, which was not paying myself,
Right.
which now in retrospect, okay, that doesn't seem viable, so whatever kept it up.
Yeah. And I'll say too, like on the viability of not paying yourself, I I want to make an amendment to what I said earlier. You don't if the business is in a phase where you really can't pay yourself, but you could kind of operate temporarily if you have other sources of income until this time, you have to sometimes have to make that decision, right? I've had those times where I had to like defer salary. But one thing I've never done is not accounted for my salary. And again, I think it's uncounted, right? So if I want to pay myself $5,000 a month, I may only be able to pay myself 2,000, but I put in payroll expense of 5,000 every month, right? Because what again, you're training the business to actually be viable, right? Because eventually, at optimal thing, at better times, you want that 5,000. So you keep showing a loss, and again, loss versus cash flow. Sometimes you may have a loss, but it may not always be cash flow negative. Sometimes it's both. So I guess the long and short of it is I can't say yes, this, no, that. It's not, again, this is not academic, right? It's like the economy is like a little bit of science, mostly it's art. So you have to feel it. You have to see that foot traffic, if that's a business model, increasing. You have to be hearing people saying, asking about you, right? You have to be sometimes you just know when it's starting to turn the corner. You could feel it sometimes, you know what I mean? And you have to go with that gut as well. But again, there's a limit, right? Don't let the business kill you. Literally, figuratively, all ease. You know what I mean? So that's something that you have to kind of go with internally and continue to monitor it. You know what I mean? And I think if you listen to yourself, you look at the landscape of both yourself and there's another metric too. If other like-minded businesses or other competitors are thriving and you are not, you are in the right industry, but you're doing something wrong, right? And you need to look at how I could think of some industries are dying, period, because things are changing, like paper sales. Don't get into paper sales necessarily. Um, so some industries just go up, right? I wish we had time to talk about that today, but like, is again, I said earlier, always have a number in terms of how much you want to have in your bank account, have a number as to what you want to pay yourself. always have a number as to what your business is worth as well. That's a little bit tricky too, but that's what you call a business valuation, right? And it's not like always like so hefty of a it is a mathematical equation, but you also forecasting, also guessing a little bit too in there, and you're putting a little bit of value on your sweat equity as well. But you always want to kind of have an idea what your business is worth. Yes.
And that's when you go to the slide, then your potential investor.
Absolutely. Well, that especially that's when it's most needed, right? So I don't know if a typical business plan for financing is usually looking for, here's what I think the business is worth. But when you go into for investors, in terms of like equity investors, especially, they want to know, all right, if I put in $10, what is this going to get me? Right. And so that's it'll be good, right? And again, it'd always be good to have like a licensed valuator or CPA do a business, a business valuation for you. That costs money, but you could also just you could do some research. You could use AI, you could use Google, and say like, what is a typical, what's the formula for valuing a company in healthcare, medical supplies or whatever it is. And then you could take that and you could just use it and say, okay, you look at your sales, you look at your net profit or your losses, and you put those figures in. And then, you could kind of get a value, right? So like, this is some free advice. So like if you have a business, any business, and you want to say, okay, what is my business worth? Take your revenue, your average revenue for the last couple, unless if you have steady revenue. So if you have a steady revenue in the last like 3 years, take the average of that revenue, multiply by 1.5. That's kind of what it's worth, right? So if you make $300,000 a year in revenue, now you might be like zero profit, right? But you could say I could say I'm worth 450. My business is worth $450,000, and we spoke about this when we went on the on Shanique Miller show the other day about somebody mentioned it was a political conversation, which is not always the best method for these types of conversations. But it was about inner city businesses being taken over by non-Bahamians. Now that's a term maybe I should be careful how I talk about that. But a Bahamian is anybody who have Bahamian passport. That's a Bahamian to me. Some people they need you to look a certain way. So people say, oh, these Chinese. A lot of those people are Bahamians, right? They may not look how you think they should look, but they Bahamians as well. But even if you say, all right, foreigners buying traditionally Bahamian businesses, a lot of times, especially over the hill or especially in typically mom and pop type areas, that is usually because it's simple. You have a tuck shop or you have a convenience store, send the kids up to school, they go to doctor, lawyer, whatever it is. They come back or they don't come back at all. And now you old, you might be 60, 70, 80. 60 is not old. 70 is 80 ain't even old, but you're older. I gotta you're older. You're old. You more mature in life when you say, I don't want to be doing it. I don't want to be stocking up these shelves every day. And my son and my daughter, they don't want this business. So, you know what I mean? Somebody is gonna come, especially if you're making money, especially if people in and out of that, somebody can come. And they may not look how the average Bahamian might want them to look, but the average Bahamian ain't doing it. So you walk and say, look, Mr. Rule, how much you want for this business? I don't know. I sure would make me an offer. All right, I'll give you $100,000 sold. Just I want a building. Give me a couple $100,000 for the building. Easy. And now they expand that now, put on a second story. Boom. All these foreigners taking over. There's some things that we need to do internally as business owners to know where you at in the life cycle of the business, how much you're worth, and also Bahamian capitalists as well need to take a more active role in doing these things.
Business is about culture. And now culture, I find that you have a very selfish culture. I was telling my mom about my business. Don't tell me. I'm like, but why would I not tell you? That don't make no sense. But I need to know if they would actually like the product.
Right.
What do they want to do? You know what I mean? Like you have to tell them, but it's always this secret. You don't want to know who, every time I go into business, pay attention to that. They'll be like, a foreign investor would not like to be named.
the secret business culture.
Right.
We need to stop that, and we need to be more open and discuss, because we are the commonwealth of commerce. So we should put that in our need, make the wealth come.
Yeah.
That way, we don't have to be fighting and right?
Absolutely.
Especially when it comes to foreign direct investment.
Right.
You know, I do think that we do need to work on that, because an American buy business, we know they are like taking over. But when it's people, like, let's be honest, tend to have that, and we need to stop that. So I think that, again, secret business culture, the keeping secrets, and then they even did a statistic in the Bahamas where they said, for the second generation, business is gone.
Absolutely.
Because we keep them secrets.
Yeah.
That's how we keep them secrets.
Yeah. Yeah.
We done it.
Yeah.
We even done it all.
Yeah. Right. Marcel put it out there, right? Yeah. Now, I will say in certain instances, mommy, she have some wisdom for you too. Right? So some days you got to keep, my grandma tell me some days to keep, some days to give, right? So there's a balance in there as well. You understand? Especially like if you're talking about a proprietary product, like something that you actually thought of in your mind, it's not out there. You don't might not want to blast it out to your boys. You know what I mean? It depends. So that's a, you know what I mean? But I do agree. Even in our friend circles or our communal circles, one thing that we don't do, I find enough, is we don't even discuss money. We don't discuss, and I'm saying, oh, how much you making? You gotta go to a lot. But we don't discuss goals. We don't discuss like, okay, what you see, like what you want to make, like what you think is a good salary, how much. So me and my friends talk about it, not that often, but we do talk about certain stuff like, hey, boy, dance, looking at, you know what I mean? We don't talk about, like, it's almost like that's like a cap secret. But, you know, we do need to talk about, because other groups of people do discuss money. They sometimes discuss in-depth money issues as well, right? So I agree with that too.
Oh, I found in my, I discussed with some, but I'm so excited. And wherever their area is, I want to see them grow and prosper.
Right.
And I put out some marketing stuff, and I have people, hey, that's awesome. I want that, and I get all the things they want to do. Then when it comes time to discipline
Right.
and actually implement, put structure to it.
Yeah.
That's where the fall down comes.
Absolutely.
They're making the money doing it all kinds of things.
Right.
If you require the cash, oh, you need the license to bring this car, you need, but that's.
Yeah.
They don't.
Yeah.
That's the problem. We are far.
Yeah. Right.
It's so tough to create it. I say, come on, put your little logo and that's the girl and make the tools, second fellow like this and display and all that, and be excited and talk. Oh, God, done talk to people and I hear all that stuff. Oh, wait, I know you cannot. Woman says she can talk to you, you can put your hand on, set it up right, officially on.
Right.
Yeah. She got the people in here.
Yeah. Yeah. That's the thing. I mean, like, yeah, that's a big part of the problem too, right? I mean, and some, we ain't getting into like the psychology of sociology of that, right? You know what I mean? All right, so let's get back into the numbers. All right, so we have a model. I actually had one that I had already filled out, but let's go from scratch here, right? So this is what you would call, y'all see this in the back? Let me maximize it a little bit more. We can just go straight through it. Straight through it. We can do it together. All right, so let's go from the beginning. Give me a name, give me a company name. Say again. Blended Creations. I love that name. Blended Creations. Okay, Blended Creations sells what? Mixed media art, handmade crafts, right? Media crafts. Okay. So we said this earlier, right? When you're doing a break, when you're doing your forecast, let me back up for a second. What is a break-even analysis? A break-even analysis is a forecasting formula that says how much sales do I need to make to like just like hit zero. You know what I mean? To where the business is what you call self-sufficient. If I make $100,000, I spend $100,000 That's it. Zero net profit. That's a break-even analysis. Stress test to tell you like what's the minimum you need to make to like not be going in your pocket and putting money in until so you could hit your goals at the end of the day. Right. So just like how I said earlier, this model, as you can see, all you can see is cost, 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 cost. The revenue is one little small, well, it's not even a revenue number, right? But it's one line at the bottom to tell you how much you need to make, right? Because revenue, again, is not predictive. It's not predictive. So we can go through the cost, right? So cost of goods sold. Anybody can tell me what cost of goods sold is? No?
I'll try.
Yeah. Absolutely. That's exactly what it is. It's direct cost. So if you sell straw handbags, the straw that you purchase, the any I don't know the what else? How you make a bag?
You need handles, you need, the threading, you need rough fairs,
Right. Right. And if you have a logo that you put on it, you put your logo on the front. You know, you got those little metal thingums, all that goes into it, right? Yeah, I don't know how to do a lot of stuff. But all those costs that go into it and the labor that it takes to make those bags. So if you are a person who a business owner, but you don't actually sew them together or stitch them together, you hire somebody to stitch it together, that labor cost is a direct cost, right? If you want to import those stuff and you have to pay, well, VAT is, we net off VAT, unless you can. All the customs, environmental levy, all that stuff, that's all a part of the product, the cost of the product, right? So, if you customs duties, all of that, landed, they call it landed costs, right? So if obviously landed costs for a huge bunch of stuff to make smaller products is going to be a bulk cost. But let's just say if you could break it down, and there's always a way to break it down. So to make every bag, it can cost me $17 for all of the materials for one bag, for one hand bag. That's my cost for that, right? That's my materials cost, right? You have labor costs as well. If you are the person who owns the business and you also craft the bags yourself, whatever your salary is a part of the cost. All that is a part of it. If you have to get a storage facility to store those bags until they are sold, that's a part of the cost. All that is a part of the cost, right? It's called direct costs, cost of goods sold, cost of sales, right? So let's say, for instance, we want to, so certain costs are variable costs and certain costs are fixed costs. What is that? Fixed costs easier. So no matter what you do, your rent is $1,000 a month, $1,200 a month, right? That's fixed. So if you don't even sell, if you open and close, if you don't open and close, $1,200 to the landlord in a month. Hopefully he ain't charge VAT because then it's $1,320, right? So that's fixed costs. Salaries, unless you are able to scale up and down for demand. If your salaries are fixed, if you have 2 staff members, you have to pay them every week, no matter what. That's a fixed cost, right? So no matter how high your sales go or how low they go, if it rain, if hurricane come, then who knows? But you know what I mean? Whatever the conditions externally are, as long as business is open, those are fixed costs. Variable costs are costs directly tied to your sales volumes or what you hope are your sales volumes, right? So if you, back to the bag, if a bag costs you $17 to make, and you that $17 is a variable cost, right? So if you sell one bag, your cost is $17. If you sell 1,000 bags, that costs what? $17,000. So it goes up with the sales volumes. So if you sell 1,000, you have to pay for 1,000. So that's variable cost. So if your costs go up, if your revenue goes up, costs go up in line with that, right? As a percentage base. So our cost of sales for this business, let's just say our margins are 60%. So our cost of these items is 40%, right? So that's going to translate to the bottom line, right? So I got to put a little I don't think I have to put anything here. So for the variable cost and for this model, we only need to put in the percentage up here, right? Let's just say direct labor, an additional 5%. So our direct cost to make this bag is 45% of whatever we can make, right? Then we can go to the big ticket items. When I do on my fixed cost, I like to go in order of like the actual top to bottom, right? So the biggest cost all the way down. But since we're doing it like this, let's just go through it. And also too, when you look at these models, not every line applies to your business. Sometimes you look at a model and you have to add lines, right? But that's what the template is for. You make use of it and you tweak it to your needs, right? If you are a company that does not utilize accounting services, you don't need to use accounting and legal, right? Although I would strongly encourage you if you could afford an accountant, and if you need a lawyer, get both, right? So the salary is, and this is we doing it. Let's do for only for 1 month on this, and again, you could do it however you want to do it. So for 1 month, and I can plug in a number here. Let's just say our payroll is $500 a week. So let's say it's 4 weeks in a month, $2,000 a month. Supplies is not actual materials that go into the actual crafting of the bag, but you may need like paper to produce invoices. You may need ink for the printer. Those little things that you need to run a storefront, those would be like supplies or office supplies, right? Staples, that kind of stuff like that. So let's say $50 a month, you go to Wong's, get your little stuff, or wherever you go to get your stuff, right? So that's $50. Let's say $100. So like round the numbers. Repairs and maintenance. You may utilize, I'm sure you use a machine for that type of thing, right? So you have a machine. Okay, both hand on thing, right? So let's say once a quarter, you gotta like tune it up or something like that, the machine. Or maybe, I don't know, oil or something, I don't know. But let's just say you are, and again, this is another point too, right? So like let's say you have costs that are not monthly. They may be every 6 months, sorry, but you want to do a 1 month projection, just divide it, spread it out, right? So you can say my average monthly costs are X. So if you have a machine that you have to spend $2,000 a year on, it may not come. Let's do $1,200 a year because it's easier. It's $100 a month in short. But you may only have to do that machinery repair once a year. But if we do on a monthly projection, you understand what I'm saying? So it's $100 a month, right? Advertising. So it depends. But I think every business should advertise. There's a lot of free advertising out there. But social media advertising is fairly cheap compared to the traditional sources as well. So let's say I just have the Facebook thing. That's what, maybe $100 a month. That's max, right? It depends on how much you want to it. Okay, so what's a good marketing strategy in terms of like Facebook? How much you think you would spend a month to market your stuff on Facebook? 150, 200? So let's say 150, right? Let's say 200, right? Why are you talking to you now? Let's say 200. Car, delivery, and travel. This is one of people tend, if they don't have a business vehicle that they actually have labeled with the business, and you use a personal vehicle, people don't think about that because I have to drive around anyway. But if you just operating 9 to 5, you driving to work, may get lunch, drive home, that's way different than making runs. And we know how some of these roads are. So that's a major cost, right? So for instance, I have a vehicle that I purchased, um, not for the business necessarily, but I purchased it through the business. And that's a vehicle with which my children get around day to day. I booked that into the business. When I got to change the tire, I don't book the gas, right? Because that'll be fraud, basically. But like when I gotta change tires and stuff like that, that's a business vehicle. The business owns a vehicle. I booked that into the thing. I gotta change the tire when the tire bursts, or I gotta do some sort of repairs when the window ain't working. I booked that to the business. Hmm. Hmm. Yeah. Yeah, so that wouldn't be direct cost, but that is, and it sounds kind of like, huh, but that's real. If your business is your hands, whatever it takes to maintain the health of those hands, to make it for the product to actually be made, you factored it in. Now you don't want to abuse it, right? So if you go into Mandara Spa or Espa, whatever that, just to get a back massage on a Saturday because like it's your birthday, that probably is not a business expense. You know what I mean? But if you actually have, because it could even be therapy almost. You know, we got carpal tunnel and all these different things, rheumatoid or whatever it is, arthritis and that kind of stuff. So that's real, right? So car delivery and travel. So let's say you got the minimum, you gotta, put gas in your car and you're running all around town. Let's say you have a small car, that's still probably about $80 a week. I don't know. You might get filled up twice. You might have to do fill up twice a week, right? More than twice. Say, see now, so let's say $100 a week, $100 a week times 4. Let's speed up a little bit. Accounting and legal. So let's just assume that you don't have an accountant, but you just use QuickBooks. So the average QuickBooks subscription or a small subscription, maybe like for one user, maybe $30 a month, right? So that's $30 a month. Rent. Do you pay rent? It depends. Let's just assume we're paying rent. So let's assume we have a small space on Carmichael Road. What's that? $1,000 a month? $800 a month? 1,400? Yeah, see, 1,800? Wow. And Carmichael Road is prime too, right? Like that's prime real estate as well. 18.
So. Federal grant. It would be with that.
So it depends, right? So like if you work from home and your business is not causing additional expense for your living, then there's no rent. But you could always allocate portions of your utilities to your business, right? So if you, and again, the past performance could equal future performance, right? So if there was probably a time when you didn't use your apartment or your house to do your business, and your light bill was only $150 a month, and now it's 400, that ain't magic, that's business expense, right? Now there's some inflation in there. So let's say now, okay, that was 3 years ago. We had to do some stuff, the surplus gone up, whatever, that's the surcharge going up, so it's probably 200. So the other half is business expense. So that $200 you can put at the electricity, right? Now, whether or not you reimburse the business for that expense, it depends. I would encourage you, if the business is healthy, I would encourage you to reimburse the business. See, it depends. I mean, because it's going the other way, right? But I like to do things like this business, like I don't even know these people, and it's my business. So I just do like one-to-one. So like when I go and I swipe my card to get my shirts branded, I transfer the money right away because I you know what I mean? I own it, but that ain't me, you know, that kind of way. So so that's how you do it, right? Any again, even like with vehicle, right? So like you may not be able to say book all of your gas expenses to your business, but if your gas bill has gone up, again, that's not magic. That's the business operating. So whatever that difference is, that is a business expense, and you book it there. And again, train your business to like actually like operate properly and sensibly. You know what I mean? So telephone, if you have a $50 a month plan or whatever it is, so utilities, let's say, so we rent in here. Utilities tend to be a little bit smaller for these types of, how much you want, but $300 a month? Insurance is very important depending on what you operate. A lot of businesses don't have insurance. I understand it is very expensive as well, depending on the type of business you're in. If you operate machinery, there's high risk, so now they can push up the premiums as well. It's a decision that everybody has to make. In my profession as well, lots of ongoing kind of cost benefit analysis to do. All right, if I get myself in problems, if I do some books and it leads to a bad result, how much is that going to cost me? How likely is that to happen? If it's unlikely to happen and the cost is fairly low or the cost is really high, I may say, I'll just take the risk, right? But if the likelihood is high and the cost is, even if it's high or manageable, you probably have to do it, right? If you operate a boat, for example, you better get and y'all know things will happen on these boats. Get the insurance, all right? Because you don't want to be now, you know what I mean? You in the news now, right? Now you in court and they looking for your personal assets, especially if you don't have the company formed properly. And that's so important as well. I can't get into all of it right now, but when you do it, assess the nature of the business, assess the risk involved in the business, and where possible, it's an expense, but if you can form a separate legal entity for your company and let things run through there. Because then you have limited liability. If there's no structure and you operate, especially if you just have your personal account, money coming in, money going out of your personal account, somebody may get in a little, they may bug their toe and say, I want whatever is another account, whatever y'all dealing with personally. You got a nice car, you live in a nice house. You know what I mean? I don't know the law like that, but you just, ignorance of the law is a time for structure. That's how I operate as well. So insurance, let's just say our insurance, if we do get insurance, is a year. 2,700, let's do. Taxes, this would be like, so I have a line when I do financial statements, it's government expenditure, right? What we can do is, because business license is a fee. And that's, I would consider that a variable cost, because so if you over a certain threshold, you pay 0.75% of your revenue every year goes to business license, right? So we could put that, we could put that up here. Hey, let's change the name. Let's put regulatory or something like that. Huh? It's too high? I mean, okay, well, we could go back. Now, granted, this is hypothetical. Uh-huh. I did it for the full year. Good. Yeah, we doing a month. So thank you for correcting me in that. Thank you for correcting me in that. All right, so let's go back to that. And again, we don't get too caught up on the numbers, but let's just say that's what, $200 a month, something like that, roughly. But that's even too high. You say that's, let's say $100 a month. So that's what, $1,200 a year, because we're doing the handcrafts and online media or media art. So taxes, we could exclude that line for now. I mean, there's VAT implications in there. Are you a VAT registered? Are you not? Let's ignore that. Interest. Do you have a loan through the business? If we're talking about, so let's just do a simple model. This is not going to be accurate because loan is done compound interest, right? And that's a formula for another day, right? That's just simple interest. And we can do it right on the side here. So let's just say you have $100,000 loan. This could be easy. Nice round numbers. Let's say $120,000. Right? You pay that over 10 years. 10 years, and your principal payments are $12,000 a year. That's 1,200. That's $1,200 a month. No, that's what? That's $1,000 a month. $1,000 a month. My math is bad. It's embarrassing. And on that, you pay 10%. So your interest cost a month is $100, right? So we plugged it in here. Depreciation. Remember we talked about depreciation at the very beginning. That's a non-cash activity, but it's something that is relevant. How much for machine to average machine to be able to $500? Okay, that's a good point to raise. When you're talking about capitalizing goods, it may be an asset, but there's a threshold with which certain things could just be expense, because so the number that I have in my head for a typical small or medium-sized business is $1,000. If you spend $1,000 or less on a piece of equipment, you could just expense that, because even if that will last you 5 years, the monthly depreciation is going to be like $6, and it's really irrelevant at that point, right? So it's like, we have materiality and like certain things, like we don't want to get into the weeds and everything. And that's how accountants deal, generally speaking. So we could just say, all right, we just expense that, right? So we don't have a depreciation expense. Miscellaneous. I would like to call miscellaneous a variable expense as well, because we don't know what's going to happen. So like maybe like a 5% contingency fee or something like that, right? But let's just call that a month. Let's call that $500 a month. You don't know if the water line will burst or something like that. You need to get that fixed. So then we go down to the bottom, right? So we'll be looking at here. So before you buy the first piece of, just looking low. I ain't sure about this. Maybe, yeah, this might be right. This might be right. So, and this is for 1 month. This for 1 month, right? So we'll be looking at there, $125,000. So imagine if you work operating from home right now, and you selling as you go, you making a couple $1,000s a month, right? Let's say you're making $1,000 a month. It helping you with the lectures, right? It will pay some stuff for that, or maybe that's savings for you, right? Now I want to scale up. So this is what I did to see if like what I got to do to make the minimum. Let's just say I right now just making $6,000. Let's not even $6,000. Let's say we're making $3,000 a month, just selling bags on the side, right? And out of that $3,000, we save 1,000. Very efficient business. All of a sudden now you scale up, you have to make a minimum of $10,000 to break even. This is what we talk about when we talk about making decisions and having the data to back up these decisions. Because people say, oh, you know what? It's time. I scaling up now. I get in the storefront. I want to do the whole shebang. I can get all of the windows tinted and everything like that. We got a grand opening. We doing all these things. We can buy a vehicle. We may even do a giveaway. I mean, I see companies that are operating losses and they do donations. I said, all right. May the Lord bless you. You know what I mean? People, you know, again, I'm not trying to be derogatory here, but there's a certain level of common sense that needs to be exercised at all times. Let the numbers be a guide. It's not all math, it's not all academics, but they go hand in hand, right? The vision and the practicality have to marry to make the product and the business work. So this is a simple example. And I don't think we went too high. I don't think we got nothing crazy. Maybe the rent. No, the rent. If you're on Carmichael Road, we paying. I can go with the y'all are experts in y'all fields. I'm not an expert in rent, and I don't operate in certain areas, right? So I lean on y'all. So that's just a very simple example, right? And I think y'all got these templates. Okay, so you could do this you could do this exercise if you want to play around with a new concept. You know, it's just play around with it, and just tell you every month what you have to make, right? It may not be enough to stop you because sometimes, again, some people have you may have a very magnetic personality, you may have the charisma, you may have connections. Yeah. Your circle may be very influential and very, you know what I mean, proactive and supportive for you, that these numbers may not even measure up to what you actually achieve or can achieve. But again, let your conscience be a guide, let your spreadsheets be a guide, right? Sure.
Say like the cost would be 40% of your expense, the entire expense.
Right, right. No, the 40% is 40% of your revenue. Yeah. No, yeah, 40% of your revenue. Yeah, exactly. Right. So if you make $100, $40 is actual cost, direct cost. There's a formula. Yeah, there's a formula in here. I also use a break even. All right, let's look at the formula. This is in my spreadsheet. I mean the math works, right? So basically what it does is it takes the expenses. Let's just break it down for a second, right? Say again. All right, okay. No, I got you. Let's do it another way, right? Let's do it another way. So let's just take the fixed costs. Let me. I like a good challenge, you know. Fixed costs is $5,600, right? Right. So variable costs, revenue, and we could actually plug this in, right? Because again, this is not my sheet, but we could test it another way. So what we can do here is we can say revenue minus variable costs minus fixed costs should get us to zero, right? Our variable costs would be 46% based on this of the top line, which is revenue. So this is a test. So if I plug in, let's just plug in the number to see if the formula actually works. I can plug in the exact break-even number, negative $26. So that's pretty much perfect, right? Again, I didn't put the sheet together, but I see the methodology because I mean, again, it's my mathematical equation is just you could flip it any way, right? So that's more how I do it. But this is better because it doesn't so now if I try to guess, I plug in $11,000. Oh no, that's a little profit. So now I'm plug in, that kind of way. So just to prove that the actual formula works, you have to sell about $10,500 worth of expenses a month. This is kind of how it goes, right? That makes sense, yo? Okay. Okay, but it is important to trust, to be able to trust these formulas, so, question? Yeah.
So preparing some costs, I just, having your projected revenue to make this assumption.
Exactly, exactly. And when you coming up with your projected revenue, right? Like you want to be able to nail it down to the most granular point possible. So if you sell a bag at for $50 or $100, how many bags can you reasonably expect to sell on a daily, weekly, monthly, yearly basis, right? All products, all products. As a matter of fact, when you're doing your sales projections, every every sale item, or what do you call it, every product has its own formula, separate line item. And usually when you sell products, your actual your margins vary, right? Some products, depending on the type of store, type of industry you're in, some products are actually loss leaders, meaning some things you sell at cost or at even at a loss. Because like, let's say for example, you want the real product is the money maker, but to get people inside, you feel like put candy in the window. Now, candy you might not be able to sell candy at the same price that the candy store selling for, because you know what I mean. They have a cheaper price, so you sell it at the same at cost to get them in the store. Oh, I want a piece of candy. You know what? I want this. I'm not. You know what I mean? So you got to be strategic with it as well, right? And that's why you see certain stores like I use that as an example, but really like some stores that have nothing to do with concessions, they sell like snacks and stuff. And I'm like, why you selling snacks? But kids is in there, you know what I mean? Mommy, I want, daddy, I want, mostly mommy, I want. So that's good for me. But you know what I mean? So yeah, so every product line. So if you have a diverse product line, every product has its own line with its own formula. So it's almost like, so but what you could do if you again, you really just doing, you want let's like back of the envelope type of math. If you sell, yeah, if your variable cost vary from 20% to like 80%, average it out, that's 50%, put 50% there on average. You know, the kind of way. Any other questions? So it depends. Are you open only during those seasons? Okay. Okay. Right. Right. So I would say if you want to be open every month, you want to average out for 12 months. If you ask like a lot of restaurants, for example, they close for like 6 weeks to 2 months, especially on the out islands, because it's like there's no activity at certain times of the year. And so like it may be relevant for them to just open for 10 months. However, this is an important point too. Even though you're only open 10 months, sometimes you still incur costs and closing, right? So like you see like when you close and open up, now you gotta repair it, all sudden stuff break. Because that's when things are at a standstill, things break apart. That's just kind of how it is, right? So now the window gotta be done, and so now the door frame all messed up. So there's sometimes, depending on the type of business you're running, sometimes cost even when you're sleeping. So you have to kind of build out your model to that, right? So in an instance like that, let's say you open 10 months of the year, but you have a storefront, and let's say it's on by the seaside. So like the sun, I mean, it's all damaged, that kind of thing, right? In the 2 months that you're closed, you could build into your model zero revenue, zero payroll, zero extra everything else. But there's a line item for repairs and maintenance in there. You know what I mean? And it may not be exact to the dollar, but if you have an average idea of what it's going to cost you, when you open back up, that $6,000 you estimated for those 2 months of closing, you spend it on the guys to come in and fix these things, and then it kind of evens out. You know what I mean? So it just it depends. Unfortunately, a lot of things it depends, but it depends. Okay, so let's go now to here's my profit and loss sheet. Let's get a template up. Let's get a template. I had my own, but it's like, let's just go from scratch. Yeah.
Stop.
Any other questions, all of you, waiting? Thoughts? No? Yes, ma'am. Yes.
The revenue. Then it was still that public revenue.
Yes.
That'll be the level four, we brought up with that just point.
Well, that's an average cost of all of your product offerings, right? So if you sell 10 things at varying rates of profitability, I would suggest do it, so if you guys, hang on. So say, here's what you do, right? So if you say, and again, this ain't gonna be exact, right? You sell 10 things, five of those things go $5, sell $10, right? And let's assume you sell them in terms of volumes, the same volume. So you sell exact same, right? Right. You could average you could get an average sale price, $7.50. Right? Multiply that by your average sales, and your expected sales volume for the month of the way up for the year. Right? And then your variable costs will tap into that $7.50 per product. I can say $3, and it can go up or go down. And the other thing about doing models in like an Excel as an example is if you have input change, everything else flows like that. Yes, yeah. Once you change the base number on which the calculations come from, so the revenue number is per unit cost. The revenue number is the sale price, is the baseline, with which everything ties in. You change it from $7 to $10, then you'll see a different, you'll see a different calculation.
Yes, ma'am. Okay, all right, so my question is a bit harder to think. So we had a question about if you have multiple products, and this is for the benefit of the Zoom callers. If you have multiple products, how do you calculate average cost and variable costs? So basically, there's a very simple idea where if you have 10 products, you could put in all of the products, the costs. So not the cost, the sales price for each of them, get an average sale price. And then if you have different margins for each of those, put in the average margins for each of those. And then it'll give you an average sale price, average cost per product, and I'll give you your average margin or your average cost of sale. Okay, now we're gonna go into we can go into the profit and loss. Oh, it's here, but it's just not wide enough. Let me expand this one. Okay. So this is an income statement. We're gonna go with the same. 1 second. So, I was trying to find it. Let's use blended creations again. All right, yeah. Blended creations. And what I want to do, just to save a bit of time, is I want to preset the things that we use from the other example, from the break-even example. I can put them in here. Unless for this one, let's do for a month. So let's just do July 19th. Why did I say July 1st? Okay, it's fine. Let's do it. Oh, July, okay. July 19th, 2025 to August, what, 18th? 2025. So that's 1 month. So that's today all the way to the middle of next month. I'm gonna put in now these numbers are hard coded, but I'm gonna put a formula in here. So we already know that our cost of goods sold, based on the other example, based on a break-even analysis, is 46%. So I'm gonna put in 46% multiplied by my gross revenue. Gross revenue, this means sales minus, well, that's not, yeah. Sales plus or minus like discounts and returns, right? So that's your revenue. So this line, I highlighted it so we could recognize it as we go. We said that our rent was $1,800, right? So I can type that in. And so this is now not a break-even analysis that we're doing. We're doing now what we expect our 1 month operating is going to be. 1 month of operations is going to be. Our utilities, I think we said, were $300. Wages and benefits was at $1,000, $2,000, $2,000. All right. Internet and phone, office supplies, I think that was $100. Supplies, $100. This is, yeah. Well, I mean, this small house is separated, but yes. So when I account for my operations, I account for, well, I like to have it a, a large group, but I have it subcategorized too. So I have utilities, electricity, phone, what else we got? Water, internet, and I even put like if you have like a gas tank, I put propane and utilities as well, because to me that's utility and waste collection. So if you have Bahamas Space or one of those guys come to kill it, I put all that together. But the model has a little different. So let's go with the model here. We don't need to put too much more detail in here, but let's just say no travel. Travel expense. Sometimes people look at travel expense and say that's a personal expense, right? And sometimes people do travel personally and put it on the business account. But if you have to travel to buy product, that's a business expense, right? Travel. Yeah, travel. You have like travel, like general travel expense. You have like selling expenses. So like if you actually travel into like Andres or conference to actually try and make sales, that's a selling expense, right? Some people consider that even a direct cost, but it depends. It really depends. So like if I go to like a sales conference or a trade show or like a chamber of commerce meeting, and I try to sell, but I don't sell, I would consider that a general expense. If I go to something and I actually sell product, maybe I would consider it a direct cost, maybe, right? But it's probably safer just to put it in general, right? But let's just put, instead of going through all the other line items, let's just put additional cost of $700, right? So we know now what our fixed costs are. Our cost of goods sold number, that yellow highlighted number, is just waiting for me to plug in the revenue, right? Now, we know we have to sell $10,000 worth of bags and crafts and media to break even. But what are we really thinking that we're gonna sell, right? So let's just say, I'm gonna do this quick. What's the average sale price of a bag? $65, right? How many bags you think you could sell on a monthly basis? Or you, yeah, right. Okay. So in peak season, 50? Okay, so 50. Now we also have the other part of the business, and this is where we get into the pricing of different types of products, right? Now I know media is a little bit more, it just depends kind of thing. Like you have different types of things you provide. But let's just say you have 5 projects a month, and I'm gonna say you could probably charge $800 per project. That's too much. I don't know. Let's say 350. All right. So we add those together. So we could already see we in trouble, right? Now, hopefully the actual revenue with which we're basing our model on does not have these same expenses. But before I even plug the number in, we know that our expenses, fixed costs, no matter what happens, is just over $5,000. If our sales is $5,000, we haven't factored in the direct cost yet. We're already in the hole. We're already in the hole, right? So let's just bump this up a little bit, right? Because I want to see something good. So let's double our handbag sales. And let's just say, you know what? we can charge a bit more for our digital media. We can charge $100 more, right? So we still in trouble, like I said now. But I can just I can link this, right? So we sold $8,700 worth of product. Our cost is just over $4,000, just 46%. So when we scroll down, we ain't do too bad. We ain't do too bad. So we almost break even here, right? Again, this model is a little bit different because we didn't use the exact same line of the thing. But this is a good example too, right? And we didn't even factor in like interest. Well, I mean, I put in a general line at the bottom here. But this is a nice little model. When you're doing a typical profit and loss statement, it just goes in one straight line. But this is, I think, just for the visual. You got your revenue at the top, expenses, profit or loss at the bottom. Again, we talked about a lot about cash flow at the beginning of the session. This is just profit and loss. So let's just suppose as an example, you know what, I want to see some profit. I'm a little bit greedy. So I can change this number, right? So our number goes up $10,000 for the sales. So we make a little couple $100. That's good. That's a good month. $500 is good. $550 is good. All right. But let's just say as an example, and I want to test the cash flow of this, right? Out of this $10,000 we made in revenue, we have yet to collect $2,000. I don't have to plug it in, but I'll plug it in. I'll do it right here to transform this into a cash flow statement. You see now we now in the whole $500 because that $2,000 from this customer is delayed. Hopefully it's collectible. But one thing I didn't mention that I want to mention here is there's a accounting concept called aging of receivables, right? And again, I don't know if your business is set up like that where you have like all of these sales that you generate, but you get the money later. I recommend if you could do it, get the money up front, right? Depending on the business that you're in, especially if it's like a transactional. Well, if it's a transactional thing, you better get your money up front because after that's gone, right? If it's a business relationship, if it's an ongoing relationship, then you could probably extend a bit of rope, but be careful with the rope. But the longer the time somebody owes you money, the less likely they are to pay you. So that's a fact, right? And think about it in your personal life too. Somebody owe you money from like 2 years ago, they borrow $400 to do something, they sue or something like that, you ain't never getting that money back. You will never get that money back, right? So keep that in mind. So you want to keep your receivables. There's a term if you all are not familiar with it. But 30 days, no longer than a month, right? So by the end of that month, I'd say even 2 weeks, right? Unless you have, so for me, I only have like about 10 clients. So I have a very personal relationship or a very intimate relationship with my clients. And I get burned by that from that too, right? But like, it's not like I have 100 different people I deal with. It's only 10 people. So I know just where to go to get my answers, right? Hopefully it's a yes, or the money's in the account. Oh, perfect. But if you have a lot of different customers you're dealing with, cash up front. And man, I want to say some stuff about family and friends, but I won't. I don't want to offend no one. I don't want to offend anyone. But my grandma used to say, what they say? Business and family don't mix, or business and lovers don't mix, right? You know your family, you know your culture, you know your friend groups. So if you could trust people, then you trust them. But I don't. Trust is a very delicate word for me, right? We doing business. We don't. A stranger will do business. I prefer a stranger. You know, even if I have to have a tough conversation, it ain't all this. Oh well, I don't know. Actually, don't know you. So I actually don't know you, so I don't have to empathize, and again, I talked about this sympathy, not sympathy, but having a personal touch to your business is important. But tell you one thing, if you're getting evicted and somebody owe you $2,000 that could cover the rent, and you call them, you ain't sure they're gonna give you that. So I try to keep things above board, and they call it arm's length transaction. So arm's length is like you keep them here, and whatever space between y'all needs to be kept, that means that's supposed to be kept, right? So you hugging somebody, you don't lose. You hugging them, you kissing them up, you probably ain't getting no money. Keep them treat them just like a stranger would, right? Just like that. All right, we dealing. Now, okay, you pay me. All right, so where the family function? Let's go. You know, any questions on any of that we just did? Nothing? Any comments? You?
I mean, that's something, yeah, my brother was pretty mad at me because I didn't want that of it. I was like, no, I have to, not to be me, but I said, I left already.
Right.
I rather do something great because if I gotta tell him something.
Yeah.
I'm dead in that.
Right.
I'm dead in that.
Right. Right. Yeah.
And, other problem we have sometimes is body to everybody, or because, you know, I remember when I was in Canada, 70.
Okay.
Boy, and people, they understood they understood the approach of business.
Mhm.
Like,
Absolutely.
they treated me like a stranger when they had it, it's like, yeah, I mean, I,
Hmm.
right, and they understood that, I think in Bahamas, we need to understand that in Europe and these other countries. Now, I'm not saying that some countries it isn't like that.
Yes.
But it was,
Right.
where it is, but for Europe and United States, I mean, for Europe, United States, Canada, and US, they were very business oriented.
Yeah. I think again, right? And I speak like this, not just with business, accounting, but like we are still a young nation, right? 50, what? 250. I should know this. Happy independence, everybody. So we are 52 years young, right? And we also a very small country, right? So most people, what, maybe 2 or 3 degrees of separation, you know somebody that I know, or we may even be related, you know, the kind of way. So I give grace to being in a society like that. And I also, in terms of how we live or how we sometimes live, how we used to live, I like being able to say, I don't feel like a stranger when I talking to certain people, right? Like if the police pull me over, by and large, I could reason with that person. Even if I might run a red light or something like that, I could reason and talk to them, even if I get a ticket at the end of the day, right? But you know, you go certain places, you make a wrong turn, you don't know what could happen, right? So I don't ever want to turn into that. But I think we could marry the two where we treat each other with respect, understand business is business, still love each other, and then get back to business. You know, so I hopefully we get. I think we maybe getting there. And again, it depends. Everybody has different situations, right? But just like I say, don't let your business kill you. It relates, and we're not multinational corporations. We're not moguls, right? We really just trying to do this off of the sweat of our brow, right? And it's a lot of work, right? And I've had multiple business ventures where I handle them, some business like, some not business like, and the results showed. When I didn't take it seriously, the business didn't take me seriously, and then the shop was closed shortly thereafter, right? And it's a formula. It's a formula. It's not always a formula, but certain behaviors are predictive of success or failure, right? And failure happens at every level. Success happens at every level. And I'll say this one to y'all too. Success looks different for everybody, right? So some people may say, oh, well, you've been in business X amount of time. You weren't driving no big car. You won't have this, you won't have that. But they don't know what steps you've made, what progress you've made in that time, right? Let's just say that, and Dave Chappelle, comedian, said this. He said that his dad was like, why you want to be a comedian? Like they don't make money and they don't do well and you have to go on the road. And he said, well, dad, like you're a teacher. You make $50,000 a year and you take care of your family. But if I make $50,000 a year as a comedian, that's success to me. You know what I mean? So again, don't be a prisoner of your goals and don't be a prisoner of other people's expectations of you because they don't know what you're trying to achieve. You know what I mean? So I think that's that's me for at this point. I'll open up for general questions or commentary or.
I have a question. First of all, I want to thank you for your presentation. It was very informative.
Thank you.
Talk about aging receivables.
Yeah.
Let's say I have receivables that I have to pay off. I'm 5 years now. I'm trying to cover the receivables.
Right.
Would that go under what, the state tax revenue or something sort on
On the income statement.
income statement?
All right. So let me tell you what happens, right? So when. Right. So the question was talking about receivables, aging of receivables. If you had a receivable that you took to a long time, you decided that it was a write-off, you wrote it off from an accounting perspective. And then years later, you actually got the money back from, by some miracle of God, they paid you back. How do you treat that from an accounting perspective, right? So you essentially would just reverse what you did to write it off. So, and I'll just type a quick entry here, right? So when you make a sale, you have basically two lines. You have revenue. I misspelled revenue. NUE. Say $1,000. And if it was a cash sale, it would be $1,000 cash, but clearly it was a receivable. So receivable, right? Of the same $1,000. Now a year later, you just look at them and say, I don't think I'm gonna get this money back, right? So what you do is you would take that same receivable and you would write it off. So basically, this is the write-off entry. So basically, you take the receivable and you would negative that receivable, and then you would also you could either treat it as this is a line and as an expense called write-off, or I like to reduce my revenue, mainly because I pay VAT, right? So if you don't treat it properly, you don't get the benefit of reducing your revenue. So if I made $1,000 last year and I never collected that revenue, but I paid on it, I want to recover that back. So I would like reduce my revenue to get that money back. So I don't have to pay the $1,000 that I didn't have, right? So let's say you do revenue or slash write-off of that same negative $1,000. So now that sale never happened, right? Well, actually, the sale did happen, and also it also depends too if you're selling products, right? So if you have inventory, that's another thing. So if you say let's take the craft as an example, and again, I don't get too wonky into it. When you sell a product, it's a two-sided entry. You have to recognize the revenue, the sale price, but you also have to recognize the loss of the inventory, right? So if you sell it for 1,000, but you paid all landed cost total $600 for it, you reduce your inventory by $600, and then you also have cost of sales. Talked about that earlier, or cost of goods sold of $600. What this entry does is this reduces your inventory on your balance sheet. So you have $600 less assets, and then that same 46% over here, that $4,700, that increased by $600, right? So that's how that entry goes. When you get the money back, what you have to do is now reverse this entry. So you reverse the write-off, or you could simply skip that. And what you could do is you could say, all right, I got the money, cash, in full. That's also rare. When people pay you late, like years later, they usually come with like, oh, I'll give you some. But if you get it in full, perfect. So you get the cash, and now what you could do is you could just rebook that revenue item. So it's almost like a new sale, or you could just reverse the write-off, however you did it. And that's how you would do it. But you want to, like, even if you end up at the same place, you want to do entries as things change. So like you want the current state of your business to be reflected at all stages, right? Because if you just like say, I can go back and just not even worry about that sale, you're not accurately reflecting what happened, and you want your numbers to tell the story, like, all right, ups, downs, and then it's like, why I was down here like this for this period, why? And then you look into it and you realize, I was doing something kind of weird. I was buying, instead of buying a bulk, I was buying like one off. I can't do that anymore. So the numbers, sometimes it could be a bit of a pain in the butt to maintain, but they really tell the story, right? And it's a cautionary tale sometimes. Sometimes it's an inspirational tale as to like, look where I was, look where I am now, look where I'm gonna go. So kind of all sometimes.
If you have to get exempted from government, where would that go on the Excel sheet?
Okay, so the question was, if you get an exemption from the government, where would I go on this type of sheet? So when we say exemption, we talking about what exactly? Like on like an expense that like let's say VAT, and they say, you know what, give me like customs.
Yes.
Oh, okay, so good. So if it so basically, you had a customs bill of like $1,000, let's use $1,000. But because of the industry you're in, you exempt from that $1,000, it really wouldn't go anywhere. So here's what I would do. That would just reduce your costs. You see? So if you, but you record it just like that. So like now, whereas your cost sales is 46%, now your cost sales can be 35% because of that exemption. Now I say, wow, man, look how the government helping me. And that's a good strategy for you, right? Anwar? Mhm. Yeah. So that's a good question. So, okay, so that's what I do, right? So, I currently in my business, I don't account for my labor as cost of sales. I just book that as salary. But I think there's an argument for it. So if, let's say as an example, you determine that you do, so like on each engagement, so like I say my jobs are engagements, right? And I have hourly rate. And I know that I say charge 150, right? I don't charge 150 an hour, but let's just say I did charge 150. But I really know the like the market rate for like that service is like $60 an hour. I may book that $60 as cost of labor or direct costs. And the difference, which is $75, something like that. I'll book the difference to payroll. So like you could split your wages as well by like that. Like if you really want to show it like that, or if you have staff members that do some of the like the nitty gritty work for you, you could book all their salary to direct costs. A portion of yours that actually did the work to direct costs or cost of sales, the balance of like some of the work you do, like maybe administrative, marketing, management, that's not contributing. That's a cost. That's not contributing to to the revenue. But if you like, if you charge them for an Excel spreadsheet, whatever hours you put in to do that, that part of your labor or your salary could be cost sales. All the rest of it is just because you name boss and you charge extra, you know? Okay.
Let's just say, when doing, sales forecasting, or let's just say a projected income. Um, let's just say in my projected income, I would have projected like sell all of the inventory that I currently have in stock. Would you consider like the, counting principle or how do I not show in the next year forecasting that I have some sort of inventory, but I have to record that as inventory purchase.
Okay, so the question was in your if in your forecast you forecast that you sell all of your existing inventory without purchasing new inventory, is that a bad thing? It's not a bad thing, but it's incorrect. Because you want to forecast your business as an ongoing machine, right? So whatever you sell, if it's actually a product, you want to have like a certain minimum inventory threshold, what they call reorder, just in time or whatever reorder point. So like if you want, if when you get to like 20% or 20 units of a certain thing, and you know, all right, depending on the supply chain, if it takes me a week to get myself in or a day, if you know, the shorter the time to get new product in, the less you need to keep on hand. But if it's stuff come from China, or maybe 2 months, 6 weeks, you probably go on order like when you like maybe halfway, right? And so how that will be accounted for is not profit or loss, but it'll count against your cash flow. So it'll be like real like purchase of new inventory.
But, the 3 year forecast, forecast or basically projection.
Yeah.
How do I now add that, I would say, now I'm expecting to reorder, let's just say, X amount of inventory based on what's in stock and what I'm ordering, well, I guess that typically, you know.
Right. So what I would do is, what I typically do is I take my year one sales projections as my guide, right? Especially if it's a new business. Um, So if I expect to sell 5,000 units of lipstick as an example in 1 year, but I know that I can't end the year with zero lipstick. I want to probably end the year either at 5,000 again for the next year or 2,500 and then reorder at the beginning of the next year. Or if I'm expecting to sell more in year two, hopefully you sell more, then you actually probably want to order more than 5,000. So it's almost like you buy, so let's say you buy 5,000 in January of the beginning of year one. And by June, you have half of that left. But it looking like, hey, next year, like sales trending up. So maybe what I should do is instead of buying 5,000 or 2,500 more, I want to buy 5,000 more. I want to buy 10,000 more, right? So so it's almost like your reorder volume or your purchases of new inventory should be based on what you think your next year's sales are going to be. So it almost like ties in. So every year you buying more inventory, sorry, to account for your increased sales the following year. So your costs, not your costs necessarily directly because you have to like you don't incur the cost until you sell it, but your cash outflow of purchases of new inventory will keep going up as your sales go up. So that's how you do it.
After we wrapped up, but I do want to say thank you so much, Mr. McCartney, for being here. Let's just give him a round of applause. And I want you to give yourself a round of applause again for staying for the entire. We know it's not easy on a Saturday morning. We know you could have been anywhere else, but we're so happy to have you here with us for our first Mastery Academy. And I want you guys to know that this will not be the last one. So I know we still have a lot of questions, and there's so many more things that we can get through when it comes to financial literacy and being fiscally fit. So we will definitely be having another session to cover some more major and critical topics already. So you can look out for that. But right now, we would like to just close off this session. We do encourage you to network. You know, we have the name tag because we wanted you guys to get familiar with each other. So network with your fellow entrepreneurs. I think we still have a few more refreshments in the back. But with that being said, thank you so much. We will share Mr. McCartney's contact information if you want to contact him for your business needs. All right. But thank you so much and have a wonderful afternoon. Yeah.
Okay.